Good morning, good afternoon, and good evening, everyone, and welcome to the Winter 2022 IPO Bootcamp. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you'll see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. We get a couple of housekeeping items before we get started today. Firstly, let us know where you're dialing in from in the chat. We have a global audience and we want to know where you're coming from. Secondly, we're going to open up for live Q&A at the end of the event, so please submit those questions for us in the Q&A function at the bottom of your screen throughout the presentations. We'll try to get to them all. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, HubSpot, and HubSpot for Startups. We are humbled by their contributions and hope you're grateful too. Now, before we get started, I'm going to launch two polls just to get a temperature gauge on how the entrepreneurs in our audience are doing today. So the first poll, how are you feeling about your business right now? It's nearing the end of the year. Are you optimistic? Are you in survival mode, feeling a little anxiety? Let us know. We use this information to fuel the wellness programs we provide for entrepreneurs at the center. Awesome. Looks like optimism is in the lead. Thank you for voting. I'm going to end this poll, share those results. Looks like optimism is in the lead, but there's a little bit of survival mode, anxiety, and a little fear. So hopefully our programming today will help with that. Second poll I'm going to launch is what's keeping you up at night? So what are the topics that you want us at the center to host to help you sleep better and run your business faster, to alleviate some of those sentiments? So let us know. Looks like the poll results are flooding in, so thank you. All right, looks like no surprise there that finance is in the lead, but there's a pretty good mix here. So I'm gonna end that poll, share these results. Finance is at the lead, no surprises, but looks like scale, sales, marketing, good mix there. So we'll use this to inform the future programs that we provide for you, the entrepreneurs that we serve. We're gonna just cover the agenda really quick. So before we kick off our first session today is going to be an IPO market update and overview, and then we're going to jump into our first panel discussion, preparing for and staying on track for your IPO. We're then going to transition into our second panel of the day, where our panelists will share on the details around executing your IPO. And to round us out, our last panel will cover achieving success as a new public company. Please note the same Zoom link will be used throughout our bootcamp today. So without any further delay, please join me in giving a warm welcome to our first presenter to share the IPO market update and overview. Pierre Lepome is the head of equity and capital markets Americas at BNP Paribas. Pierre, welcome.
Thank you, Colin. Very good to be with you again. I mean, it's becoming a regular meeting now. So yeah. I'm heading the equity capital markets group for BNP Paribas in New York, in the US. We have worked on dozens of US and global IPOs in the past years. Unlike other investment banks, I would say we currently have a pretty full pipe of IPO candidates which are waiting for the right windows to open on go-to-market. I mean, in this presentation, we propose to focus on the US IPO market 2022, just to give you a state of the market. Also, our expectation for 23 and beyond. And we will conclude with the specific points about the SPAC acquisition alternatives to a traditional IPO process. We know that in the past we had a lot of questions about that, and I think it's an interesting evolution to mention. So maybe if we can start with the presentation on slide 2.
Looking forward to it.
Yeah, thank you, Colin. So to understand 22, we need to remember when we started. So just 21 was a perfect storm of supportive market backdrop. I mean, you have low interest rates, abundant liquidity, risk-on mindset with investors. And I would say it did translate in far less selectivity about IPO candidates. As well, you had, if you didn't like the traditional IPO process, you had the alternative of de-SPAC, looking, a lot of SPACs were available to look at how to, I would say, speed up the listing of companies. So it did translate in the highest volume ever of US IPOs, as you can see on the table here. And now if we fast forward to current market condition at the end of 22, it's a 180-degree turn. I mean, we had economic and geopolitical degradation, high volatility in the market underperformance, the different stock indexes being still in negative territory. On 21, IPO class dramatically under-delivering in terms of performing very poorly. So we get a kind of record low volume this year if you look at long historical trend. I mean, a drop of 90% of volume if you compare to the average volume of the past 5 years. So pretty dramatic here. The only, I mean, you can see the illustration on the different graphs here. The only, I would say, bright points is in the bottom right of this page is the performance of the 22 of the brave 22 IPOs who came to market. And as you can see, they did deliver a positive return, like 12% as of today, which is quite in line with the expected. I mean, it's a 20-30% overperformance compared to the most of the stock indexes. And it's the kind of in the zone of the 20-30% alpha buy side is looking for. So at least the one who came to market in 22 did perform pretty well. And maybe we can go to the next slide. We can argue that the 22 transaction were for very high quality issuers with visible profitability profile, and they came at a reasonable price. So if you see in the following two slides, this one is 21, the other one will focus on 22, but you can see the contrast when we go in the details of transaction by transaction. You can see the contrast between 21, 30 plus kind of IPO above $1 billion, very tech oriented, as you can see. Good performance on the first day of the first month, but very poor, kind of a complete collapse after that. If we go to the next slide, we see 22, far less transaction, only, I think, 3 transactions above or around 1 billion, only 16 transactions above 100 million. For this kind of smaller IPO, it was mostly biotech, which, you know, biotech companies live kind of their own ecosystem with a very specific class of investors, and they're a little bit immune from the rest of the market conditions, but they still had access to the market. And the bright point is the solid price performance. On this class of 22 did perform great. So if we can go to the next slide, what we want to see how this market will reopen in 23. It's mainly 3 things. First, of course, overall market condition has to be favorable. On the specific, if we want to summarize it, one index is particularly sensitive for us, is the volatility index, the VIX index. If you look at long historical trends, you can see that when the VIX is above 20, it means the market is quite unstable. Investors are generally quite conservative. Issuers are kind of reluctant to come to market because it's a long marketing period. So when they start the process, they have little visibility of where the market will be when it will end. So generally, we see a drop of activity, and that's what we see in 22. So luckily, the VIX is coming down a little bit. I think it's at 22 today. So we're approaching this period where if we can be for a good period of time below 20, the window will start to reopen. The second factor we are looking at is obviously previous IPO performance. I mean, if the previous IPOs have been performing favorably, you will have more interest from investors. They will be more confident. They will be willing to maybe rotate some of their winning position for new ones. So it's create a very favorable environment. So seeing the 22 performance being better, it's a good thing, except that we didn't have a very large number. So how significant it is it has to be seen. The last point we are looking at is the liquidity available in the market and is the inflow into equity funds. As you can see, it's not harmful today. I mean, we've seen a stabilization. It's not a huge inflow, and you have a lot of differentiation between the type of funds who are receiving inflow today. And I would say to summarize, we see some exit of regional dedicated funds like US or European toward global funds who can invest in every market. So on the net, we can see some liquidity coming back to equity funds, which should be again, if it's continue like that, it can create a better environment. So we think, I mean, market conditions are kind of improving if you compare to 6 months ago. We're not there yet. I mean, we still have a lot of uncertainty in the market, the inflation, the interest rates and everything, but it seems to improve, especially with the announce of the past few days. And volatility is coming down a little bit. Performance are good, but on a small number of precedent, and more liquidity coming too. So that can create. Another aspect we wanted to focus on, it's how markets are reopening after a big drop like the one we have seen this year. And if you go to the next slide, we have focused on precedent downturn. Can we go to the next slide, please? Hello? Yeah, thank you. Yeah, if we go to this slide, you can see that we have two, I would say, historical precedent of kind of a shutdown of the US IPO market. It's the one around the turn of the century when we had the internet bubble burst. And as you can see, in the volume in 22, 23 was very low. And the other one is the one we had during the financial crisis of 2008. We consider that the first one is maybe the most comparable, the most similarity to what we have seen. I mean, the nature, I mean, it was created mostly by an over-evaluation, by more liquidity coming into the market, when the second collapse was mostly a debt and leverage issue, which is quite different. So if we compare to this precedent, you can see that it takes on average a couple of years, I would say, 3 to 4 semesters before seeing the market window reopening. So if you compare to where we are today, you can say the collapse did happen really by the fourth quarter of 2021. So by the end of 2023, if we look at this historical precedent, we can expect a market to be a little bit more favorable. If we go to the next slide, we also focus on the rest of the primary market. As an ECM practitioner, we look at where the new monies, the new deals are coming from, and especially how the listed company are raising a new capital on how the market is accepting that. It's helping us to see how long it takes from a rebound in the capital raising activity to translate into an IPO window opening. And you can see on these two precedents, we're more talking about 3 to 4 quarters or 2 to 3 quarters, of rebound in the follow-on activity before seeing the IPO market coming back. And again, if we compare to where we are today in 22, you can see at the bottom of this chart that the second half of the year, starting this summer, has been quite good, on quite active. So we were seeing here also some signs of recovery, which are giving some hopes that we will see some better market environment during the year of 23. So to summarize a little bit what we are thinking today about the lot, you still have a lot of uncertainty in the market, especially regarding the timing of a potential IPO market reopening. Early next year, in next month, seems a little bit ambitious, but we can expect investors to remain cautious, bad years, bad performance of previous years. And they will certainly stay a little bit selective, looking essentially for quality asset, reasonable valuation with a clear cash generation profile. And I would say a solid preparation during the process. A lot of investor meetings, what we call test the water, maybe support from some anchor and cornerstone investor who can de-risk the placement of the IPO. All of that should come into action, we think, in the early phase of the market recovery. And as the market will become more and more comfortable, I'm sure that it will become a better environment. So that's our view for the coming period. Wanted to, as a conclusion, to come to some consideration about the de-SPAC market. It's the next slide, please. As you know, in 21, we've seen a lot of companies, rather than going the traditional IPO ways, going through a listing by merging with an existing SPAC. Market conditions are completely different today. During the year, we have seen, I would say, a collapse, of the SPAC IPO market. Very poor performance of the company, which on average, in general, you have few exceptions, but I would say on the companies who become listed through a de-SPAC, the performance has been quite negative, even more negative than the traditional IPO class of 21. And I would say more existential questions about these listed companies, which generally have very low liquidity, even compared to their market cap or their float, and very little follow-up by research analysts. The nature of the de-SPAC process makes less banks, a smaller number of banks being involved in the process, which generally generate less interest, less market making, and also less research coverage. So these companies, most of them, have a real issue how they can access the capital market. Yes, they are listed, but it's a kind of little bit of an orphan situation, if you want. What if a company is still, we still have some de-SPACs were announced today, and I would say the challenge they are facing are piling also a little bit. You've seen, again, I said less new SPAC IPOs, so less potential acquirer, especially from quality sponsor or well-known sponsors. So we've seen some names we don't really know as a sponsor of SPACs. High degree of redemption at the time of the de-SPAC. So the money which was available is not at the time of the effective merger. A dry up of PIPE money available, which was the one replacing this redemption, and we've seen less and less ability of money available for this kind of structure. The SEC requirement on scrutiny is also far higher. So it's becoming much more challenging to realize a de-SPAC today, plus the stigma of being a de-SPAC, which is, again, as a class, has very poor performance lately. So, again, a question mark about this alternative structure. So, in summary, we think 23 will be better than 22. It will take few months or a couple of quarters before seeing the window being really open, but we're equity, we're equity professionals, so we are optimistic by nature. I don't know if you have any specific question, Colin?
Awesome. Thank you so much, Pierre, for that update and also historical analysis to help us get some optimism next year. A bunch of the attendees are asking if We'll be sending the slides after. Are you okay with that?
Yeah, I'm okay with that.
Great. Well, that's a quick question answered from our end. But Pierre, thank you so much for that update. Really appreciate you joining us again for this IPO Bootcamp, and hopefully the next one in 6 months that we'll have some different data and trends to look at.
Yeah, the story will be different.
Amazing. All right. Thank you, Pierre. All right, team. Up next, our expert panelists are going to cover preparing for and staying on track for your IPO. So please join me in welcoming first our moderator, Colin Conklin, who's a partner at Wilson Sonsini. We've got Mark Greenberg, CFO at Blend. And we've got Katie Hilkemeyer, who's a partner at KPMG, and Mike Ferrero, SVP partner at Woodruff Sawyer. Welcome, team. Looking forward to this. All right, Colin, over to you.
Hey guys, good to meet you all. My name is Colin Conklin. I will be the moderator for today's panel. I am a corporate partner at Wilson Sonsini in San Francisco, and I focus on the representation of public and private technology and life sciences companies, including in IPOs, public company representation, and other general corporate and transactional matters. Before we dive into the substance, let's do a brief round of intros so everyone knows who is who. Mike, I see you up there. Mind just doing a brief intro?
Sure. Mike Ferraro. I'm with insurance brokerage firm by the name of Woodruff Sawyer. I'm one of the partners there, and I specialize in D&O insurance, and especially from that transition of private to public company.
Awesome. Katie, we'll kick it to you.
All right, thank you. I'm Katie Hilkemeyer. I'm a partner at KPMG. I lead our emerging growth practice in San Francisco. What that means is I look for pre-IPO companies, and then I take them public, and then also serve the clients afterwards as public companies.
Awesome. Mark?
Thanks, Colin. My name is Mark Greenberg. I'm the CFO at Blend Labs, a small cap enterprise software company serving financial services firms in the US. And Blend is part of the lucky group of companies underperforming. We went public in July 2021.
Awesome. Thanks, guys. So today here, we are prepared to discuss staying on track and preparing for your IPO. As Pierre mentioned, 2022 was a challenging IPO market with many companies waiting on the sidelines and otherwise delaying their plans to go public. In an uncertain market, I think we all feel that IPO preparation and organization becomes increasingly important so that companies can quickly react at the opportune window should it present. As you guys all know, an IPO just doesn't come together overnight. Among other things, an IPO is simply just a massive project management exercise that requires working groups both internally and externally. Our panel today has those both in-house and external perspectives, and we're looking forward to walking you through some of these key planning steps. And so with that background, I think we're going to launch into our first step, the IPO planning timeline. I think the first topic we're going to talk about is how far in advance of an org meeting, the official kickoff of the IPO process, should a company begin preparing for an IPO? From the panel's perspective, what are some of the specific things that require the most lead time? So we're going to start with Katie at KPMG for the audit perspective. Katie, when should a company approach KPMG about the IPO process? And then there are some key internal control or financial reporting items that you would flag as some of the most important to look at early in the IPO planning process.
Yeah, thank you. I really find it helpful when companies approach us a good 2 to 3 years ahead of wanting to go public. That gives everyone enough time to do quality audits, to understand the internal controls, and to give enough lead time for the company to start behaving like a public company and practicing that time frame. And so I would say, especially now during the downturn, this is an ideal time to start looking at what is your exit plan. If you know you want to go public, then I would say start looking for a big four. Maybe you do a private company AICPA audit 2 to 4 years before the IPO. And then you start turning and getting ready to do those PCAOB audits, which are more rigorous, lower materialities, deeper look at your internal controls. If you can have 2 of those under your belt prior to the IPO, that's where you want to be. At least 2 years need to go into your IPO document. So you have to have 2 PCAOB audits. there's different ways to retrofit and different ways to catch up and to shorten that. But if you have those ahead of time, that puts you in a really good position to understand what your financials look like. Then you can focus on other items as you're getting closer. Colin, you said massive project management. It's more than just the audit. You can start looking at your KPIs, looking at what are your key hires that you need to go public. I always say you want A players in your top levels. And so what are those? And how do you then enable them to hire A players a couple levels down so that you're ready to go? So 2 years out is what I say. And looking at, you mentioned internal controls, practicing as a public company. Can you close your books in the time necessary, which is 40 days for a quarter, to get your 10Q on file? And for the press release, are you ready to do that and confident in your numbers? And for your 10K, same thing. When are you going to do your press release? Are you confident in those numbers when you do your press release, even though the 10K may follow on a little bit later? Those are my thoughts on that timeline.
Awesome. Thank you, Katie. Mark, if it's okay, let's talk a little bit about IPO planning from the company's perspective. Katie managed behaving like a public company while still private. Can you talk a little bit about when is a pre-IPO private company you should start taking those public company style steps, whether that's forming an audit committee, meeting with an audit committee. And I think especially in a time of volatility and macro headwinds, how to think about some of those points.
Absolutely. You could always use more time. All right, Colin, and there's never enough. And sometimes finance and other parts of the organization are just get pulled and pushed and stretched. So being prepared for that push and pull and stretch is one thing that I really encourage my fellow CFOs, just to be dynamic and be understanding. And there's no one size fits all, and there's no one single playbook for IPO. Companies have different risks, have invested or overinvested or underinvested or just right invested on various areas. But certainly for us, it was really a focus on FP&A. How do we make sure that we've got the right KPIs? How do we make sure we can forecast the business? How do we think about product launch and new product development? How about diversification of revenue streams? Really beyond the IPO date, right? Like the IPO date is really it's like the engagement party for the wedding, right? Like there's a long relationship after the engagement party. And I think the longer you can practice being a public company in advance, 2, 3, 4 quarters in advance, about running a playbook, looking at the press release, looking at how you're going to do investor follow-up calls, how you're going to think about the earnings call. All these things are things that every company needs to prepare for and be ready for once the switch gets flipped.
Awesome. Super helpful, Mark. And so, Mike, like the IPO market, the D&O insurance market has been super volatile over the last few years. Can you talk a little bit about what's changed in the D&O market? And as a follow-on, how long does the D&O insurance process take? And when should companies start thinking about getting that process started?
Thank you, Colin. Sure. So yes, we have seen an incredible amount of volatility, in particular in the last 3 years. During that period of time, we saw securities class actions spike. They followed a large number of IPOs going public, so there was a correlation with that, and we see a lot of securities class action suits tied to recently minted companies. So think of de-SPACs and IPOs in that category. And at that same point in time, as class action suits were spiking, the carriers offering insurance were starting to step back and step away from providing insurance. So it created this incredible supply-demand issue where there was a lot of demand for D&O insurance and limited supply with fewer carriers. And so we saw in the beginning of 2019 through 2021, this incredible spike in both cost of the insurance and the deductibles or the retentions that companies would have to take on, meaning the risk they would have to take before the insurance would even come into play. Fast forward to this year, and now we're starting to go the other direction, and that's a good thing for buyers. We had 1,200 newly minted public companies in 2021. We look at SPACs, IPOs, and de-SPACs. So there was plenty of demand, and even as more carriers were coming into the market, coming back in because now the price was being it was being profitable for them. There was so much demand for the insurance. If we think about this year, we are down. I think Pierre had a stat that IPOs are down 89% from a 5-year average. So there's much fewer newly minted public companies today at a time where there are more carriers wanting to jump back into D&O insurance. And so now rates are starting to pretty dramatically go back the other direction, both deductibles and costs. So that's a function of the market today. And that's something that's really important, especially if you went public in the last couple of years. Good news for buyers. The budget going forward should be a lot less than it's been in the past. In terms of going back to your other question, Colin, in terms of preparation, how do we think about D&O insurance in conjunction with what Katie was talking about in terms of financing, getting ready? A lot of, I would say from a best practices standpoint, companies often know, to Katie's point, that they're going to try to go public through an IPO probably a year or two out, in some cases more. I would start to think about the strategy and the team that you want in place, the broker and the individuals, the experience level that they have, probably a cycle a year before the IPO itself. Most companies buy private company D&O insurance. It's not something that automatically transfers to when you go public. You have to rehang the insurance because they don't cover securities, this 33 and 34 Securities Acts for public companies. But having a broker that has the capabilities and the knowledge of how to make that transition, I think makes sense to start thinking about it then. For the companies that don't have that time or haven't thought about it, and now they're facing it going public, let's say, and filing their confidential S1, I would think of integrating your team. Of course, you're going to have your accountants in place. You're going to have your legal team in place. And I think it's also important to integrate your D&O insurance broker in advance of that initial S1 filing so that a process can be run. I'll pause there and see if there's any follow-up.
No, super helpful. And just on the legal side, I think from the decision to go in to conduct an IPO to actual pricing a deal, it often takes something in the neighborhood of 6 months. On the legal side, planning steps typically start 12 to 24 months in advance. And there are a bunch of things that you can do in that time period to get ready. Underwriters will typically have a standard form of due diligence request list. And then during the IPO process, you will be asked to participate in a series of due diligence calls. In sort of that 12 to 24 months periods in advance, you can connect with your own counsel, ask for a set of questions used in a prior deal, and have them run you through some of those sensitive areas. That can be, data security, privacy, FCPA, OFAC compliance, some of these hot button issues that often come up in the IPO process, and you should be able to do a dry run of some of that stuff 12 months in advance. Other areas I think to keep top of mind are make sure you do like a cap table audit. Make sure that you've got a data room set up to flip on with the underwriters can access very quickly should you start the process. And I think socializing some of the key governance concepts as well, that can be dual class or founder control mechanisms, and start having those conversations 12 months in advance. Because when you decide to go, there are going to be a million other pieces of information that you're going to need to tackle and other processes to run through. IPOs require considerable coordination between both the internal team and external teams. Building the right team of advisors that functions as an extension of the company is super important. And ultimately, it helps tell the company story in the way that it should be told. So I think we wanted to quickly discuss the key factors a company should consider in selecting bankers and other IPO advisors. So Mark, maybe we'll start with you. What are some of the key factors that you guys consider, or that you would consider when selecting bankers and other advisors? And if you have any tips for others out there about how to start to engage with banks or other advisors during or in preparation for the IPO process?
Yeah, thanks, Colin. I think, again, like the sooner you get started on building those relationships, the better. Who's providing effective advice? Who's being super thoughtful about it? Who understands your business? We didn't use a separate capital markets advisor for our IPO process, but we one of our late stage investors had an internal capital markets person that we leveraged. We leveraged that relationship very frequently. We also brought in someone into the office of our CEO to help us manage the inputs and the relationships and the connections to some of the points you were making about building a data room and doing our own internal audits. And I'm not just saying this because Wilson Sonsini is interviewing me. Our legal team at Wilson Sonsini was a really amazing partner, and they had a really strong view of the entirety of the process. And then I think lots of CFOs out there are willing to pay it forward. And again, like your mileage may vary. Figure out where you're weak or where you think your company has to make some investments, and build relationships with CFOs out there that have been through this before, or general counsels that have been through this before, or CHROs, chief HR officers that have been through this before, so you can invest in those relationships and be comfortable as you're working your way through a very complicated and difficult process.
Perfect. And are there key people, Mark, that you relied on during this process, or key process points that you found helpful, whether that's, hey, when you're 6 months out, start having weekly calls with a working group or a subset of the working group?
We did have a working group. We relied on that office of the CEO, project planning person to help us coordinate. I mean, we all had day jobs, right? Like an IPO process is like a job and a half in and of itself. And having some dedicated help was really, really valuable. But my key hires, like head of FP&A, corporate controller, and head of internal audit, were like my three like closest confidants. And having, to Katie's point, like those A players in place at the time of the IPO, 6 months before, 8 months before, 9 months before, a year before, so they can build out their teams, so we can get an understanding of where are we investing, how we can invest, over what time period, and how do we make sure that everybody's aligned so that the timeline does work out.
Great. Thank you, Mark. And Katie, we'll kick it to you. I know you've seen innumerable combinations of banking, legal, and other advisory teams. Are there some specific dynamics or elements among the various groups that have led to the most successful IPOs that you'd call out?
Yeah, I think one thing to highlight is lean on your service providers. Have someone that's done this before, who can look around corners for you and help guide with respect to what is going to happen next. Start thinking about what could be the SEC comments that are going to come back, and start thinking through some of those. I do think having the trusted advisor looking around the corners for you and asking questions. Your advisors, whether it's the accounting, the lawyer, insurance, they're going to have seen this many more times than most likely the C-suite at the company. Ask the bankers as well. What are you seeing? How is my team? Where am I short? Get that third-party perspective, well, if you can, in advance, so that you can start building out the team. And I do think introducing the folks, we all work pretty well together, the different law firms and Big Four, and we call up and allow them to start talking and having those conversations together. And in whether it's the weekly working sessions or the drafting sessions, having a part of it and having those dialogue, because somebody may say something that's going to trigger, idea from somebody else, whether that is a risky standpoint or a way to spin the story of the company differently or the KPI. But I think getting the group together on a regular basis, like it was mentioned, on a weekly basis, is fantastic.
Perfect. And Katie, do you have thoughts on the IPO process? Like Mark said, you just have a day job and it can be unwieldy at times. Do you have any thoughts on just technical accounting assistance or help from third-party firms to help through this process on some of the key, very nuanced, in the weeds comments and the like?
Yes, I think having, depending upon how strong the team is itself, having an IPO readiness team, accounting advisory, is significantly helpful. And that can be the same as your auditor. It could also be someone different. There's, pros and cons on each side, but having that accounting advisory to help manage the questions or help document what is necessary for the PCAOB is very helpful. I would say especially if there's business combinations, if there's accounting with respect to new structures for the founders and that equity, is that these are not things most people are going to have in-house and understand how to account for. And so again, leaning on your advisors, great point there.
Perfect. Mike, how do you approach this question from a D&O perspective? How does a set of advisors sort of play into mitigating risk and positioning yourself to obtain the best possible D&O insurance?
Yeah, there's a theme here that you're hearing from Mark and Katie, and that I'll probably reinforce. If you think about who cares about this process most, and what are we trying to protect? We're protecting personal and limited liabilities of directors and officers. And so you have the operators of the business who are trying to manage the cost of this insurance against investment into the company. And I always advocate, I want to see as much money go into the investment side, not buying the insurance. The board cares very deeply about this. They're not involved in the day-to-day operation. And so they're going to have a really maybe strong thought process about how much insurance they feel they need. I feel in this process, getting in front of that with the board, using data analytics to help help them ask the right question. A lot of times boards ask, what do others buy? When we think the more intelligent question is, using data analytics, can you show us what these cases actually settle for? So we're buying the right amount of insurance. So as I think about going back to some of the things Katie and Mark said, I'm thinking about the experience of the team. How often do they do this? How well are the analytics, and are they easy to understand? And is this somebody I can put in front of my board? Likely the management team is not gonna, while they may have done IPOs, they're not gonna be the expert or the one maybe trying to convince one board member who wants to buy an obscene amount of insurance that's gonna cost a lot of money and help frame the risk exposure. So I think those are some of the considerations as we think about process and integrating this into the IPO process.
Perfect. So let's take the focus from advisors to within the company. Who are some of the key hires that you need in order to operate as a public company, or you wish you had as part of the go public process? I think we're focused on who do we need to hire to go public effectively, and when do we need to hire them? And so Katie, might have you start off. We often see material weakness disclosure and in SEC registration statements, and that often focuses on not having enough resources. Can you talk a little bit about who you think needs to be hired and when they should be hired to ensure that effective financial statements are prepared in a timely manner?
Yeah, and I think part of it, I'll touch on one of the Q&As that came in too. I think one of the most important items is really the tone at the top. And what I mean by that, I mean the tone from the CEO, the CFO, in-house counsel, of the importance of having internal controls, timely reporting, and having the pride in those financial statements that you're going to put forward to the investors. We are seeing a lot of focus with the SEC right now, as well as the PCAOB, especially with the new SEC counsel, on increasing the regulation, increasing the audit quality and financial reporting from companies. And so having that tone is critical. I think to touch on the question on that we hear a lot is you got to hire someone that's done it before. I don't think you do. I have done many IPOs with first-time CEOs, CFOs, chief accounting officers, and in-house counsel. Sometimes quite a few of the whole suite might be new. I think, does that cause more leaning on service providers? Absolutely. But I do think you can hire people that have the passion at the right time, who can take your company public, starting with the tone, and then getting the people that you can trust. And when I mean you, I'm talking to the CEO, people that you can really trust. And so you start there. And you do want that, I would say, CFO there at least, I'm going to say, 18 months before the IPO would be a good time to have the CFO to really understand the company and be able to tell the story. And if you're thinking about 2 years of audited financial statements, you want your controller in there as well. And maybe during that period, if you need to hire a chief accounting officer, if you're going to have a larger IPO, maybe you start thinking about that. Probably around that 12 to 18 month also, but that controller should have been in place 2+ years ahead of time to make sure you have those strong financial statements. In-house counsel, probably set around the same time frame. And depending upon what your company is, again, Mark said that nothing is one size fits all. What does your data look like? What do your systems look like? Do you need a CISO in there earlier? Do you need the FP&A? How hard is it going to be to forecast, sales forecasting? Again, I'm going to go with that 18-month kind of window to make sure you can practice, that they understand, that they can hit that metrics. We've seen a lot of companies punished. Q1 out of the IPO did not hit their sales forecast, so their stock just plummets. So have they been operating like a public company for four strong quarters, hitting those targets and being able to forecast? So that top level is probably what I would start looking at, that 12, 18 months. But some of those key accounting from my perspective should be in 2 years ahead of time.
Thank you, Katie. So Mark, I know you mentioned corporate controller, FP&A. Are there some others within your organization or within an organization that you think are particularly important that a CFO partners with? That's a head of HR, a GC, and making sure that those teams have some time to work together in advance of really getting into the IPO process in earnest?
Of course. And I completely echo what Katie said. It is not going to be one size fits all. What are the issues that you face? My partnership with the general counsel and the CHRO were particularly important. There are tons of things that you're going to experience as you transition from a private to a public company that you're going to have to work through. Employee compensation is a huge one. Having a process for your comp committee, for your approach to your transition from stock options to RSUs, for example, or you're going to have, how are you going to approach your equity program generally? Do you have the right systems and processes in place for equity? We transitioned our equity underlying software in and around our IPO. So that CHRO is a big one. And again, I'll echo my three key pillars inside the finance organization: the head of FP&A, the corporate controller, and the head of internal audit. As we made that transition, you have to think about SOX compliance. It sneaks up on you, and it's not an insignificant effort, and it's highly technical and highly specialized. I also echo what Katie said on the technical accounting. 606 for us was we had transitioned to 606, but we do business with financial institutions, so our contracts can be highly specialized and unique. So that audit process for us was pretty tough. Again, there are things that you're going to need that are specific to your company, and making those investments and understanding the risks and the mitigants against those risks as soon as possible so you can address them and not worry about them in the quarter you go public, because there's probably other things that are going to surprise you along the way.
Yeah, for sure. And two roles that I'll plug from the legal side: stock administration. Having someone in that seat before you go public, I think, is critical. That is an underappreciated role, and having someone help prepare the process, help prepare employee communications is a critical part of getting an IPO right and making sure that you do right by the employees. And then another is a corporate legal practitioner below the GC. Having someone that can run the day-to-day, participate in those drafting sessions, help prepare the disclosure, so that when it comes to public reporting and someone says, hey, can we take out this disclosure? Or, hey, we need to add this, they've got the benefit of the full IPO exercise, and they've fielded questions not only from the underwriters, but underwriters counsel about how that disclosure was developed, why it's there, and they have the benefit of the whole process. It's particularly difficult if that role, someone who's going to run all of the SEC public reporting is in the seat post IPO. They just don't get the benefit of this exercise.
Completely agree, Colin. Couldn't echo that more. And those were critical for us too, as well as someone senior in technical accounting, for sure.
And Mike, anything else to say on team on the D&O insurance side?
Yeah, so if we think about how underwriters look at risk, they're risk adverse. They're looking for, and we talked about this, an experienced management team. Do they have the industry experience? Have they been at other public companies? Are they operators and they know what the demands are as a public company? It's sometimes the trip ups, the misforecasts that can lead to litigation, are often the case. The other thing to emphasize from a D&O insurance perspective is the actual board itself. Does the board have experience? Have they done this? Are they people who have either run themselves, large public organizations? Do they have the industry knowledge? Do they bring what specific strategic importance do some of the board members play in the overall management of the company? I think that emphasis with the combination of an experienced management team with public company experience, as well as that board with public company experience, is a really strong point to make if you have that.
Excellent. So transitioning a bit, an IPO is often a large financing and also a key branding event for a company, but it's also a time where the company reevaluates and revises all of its corporate governance. It effectively replumbs the company from a governance perspective in order to comply with SEC requirements, exchange listing requirements, and just general needs as a public company. And so I think the next topic that we're going to talk about here, what are some of the key corporate governance issues that a late stage private company should start thinking about now and addressing in advance of an IPO process? I think on the legal side, a few things that come to mind are, hey, is founder control, dual class or multi-class common stock something that you should consider as part of this process? What are some of the key defensive measures that you're going to put in place to ensure that once you're public, you are going to be able to have the tools to fend off any activism? And then also, how do you allocate work amongst your board? There are key topics like ESG. Where is cyber risk going to sit? Who is going to be responsible for evaluating and looking at a variety of different pieces of risk throughout your organization? And so maybe I'll kick it to Katie. When it comes to the audit, ongoing interactions with the audit committee, are there any key corporate governance matters top of mind for KPMG as a company is preparing to go public?
Yeah, I think I am, what I said earlier, that tone at the top, the tone from the board, the tone from the audit committee, the tone from management, is that appropriate, is what we certainly look for, and embracing offering securities to the public. And so that's really where we start as an audit firm and having those conversations. We also look at everything that you just said, Colin, with where is the cybersecurity? ESG is huge right now, and what is that looking at? And looking at, does the company have the right resources? We do see a lot. And so we are able to guide from that corporate governance of maybe you don't have the top technical person, Mark was saying, that you need earlier. So we're able to provide some of those insights and make sure that that org chart makes sense, as well as if you look at international operations. How is that looking? Do you have the right people overseas, and do you have the right oversight with those people overseas? And then we all look at the board, the right independence, depending upon where you're sitting, as well as really looking at independence is something we focus on and make sure that the company is in tune with that, as well as when you look at the different service providers and what is being provided. But starting at the tone, the top, I think is critical.
Yeah, extremely helpful. And on the topic of board, as a public company, you're going to need a majority of independent directors, and you're going to need fully independent committees. And especially in 2021 and 2020, finding, recruiting, and bringing on board those board members took meaningful amounts of time. That is not something that can happen overnight, and it's a process that should start more than a year in advance of your IPO. It's extremely competitive, especially with audit committee members who need to be qualified. They need to have a certain level of expertise. And so, Mark, maybe you can talk briefly as an executive of a public company about the importance of bringing on those people early in the process so that you can get some level of rapport so that, hey, the first earnings release doesn't come around and it's sort of your first meaningful interaction with these folks, and wanting to make sure that they're in the seat and that you guys develop some level of trust.
Absolutely. And our Wilson Sonsini helped us figure out the ramp, right? Like, because there is a phase in based on market cap and location. There are other rules. There's some nuance to the rules around independence and your board. But having a relationship with your audit committee lead in particular for me was something I tried to practice. And we brought her on more than 18 months in advance of the IPO. So that was something we had been sort of practicing. But again, just like any of the other processes, it's a whole new process for the finance team. That finance report to the audit committee that then eventually goes to the board is one that gets a newfound emphasis as you approach the IPO, and then as you go into the process in post IPO, Q1, Q2, Q3 after. So again, practicing that relationship, building that relationship, understanding where what great audit committee reports look like. Hopefully, and chances are your audit committee chair is going to have been an audit committee chair somewhere else. Understanding what a great report looks like is something that you can certainly invest in prior to that IPO date.
Excellent. And Mike, what corporate governance issues matter during the D&O insurance process? Are there things like dual class common stock or cybersecurity prep that are top of mind for insurers or for you guys as you engage with insurers?
Yeah, we've actually tracked our firm all class action litigation. So we have seen that companies that do a dual class have a higher propensity to be sued. They tend to be larger companies with a really strong following and rich valuation. So there's potentially some correlation of when you're priced for perfection and something doesn't happen, that the litigation is to follow. So they're paying attention to that. I mentioned the board itself and the quality and the strength of the management team and the board. They're checking in on diversity to make sure they're meeting the diversity. And there's a period of time that boards have to adopt some of these practices. And they do ask about cybersecurity. Is there a CISO in place? What's the board's oversight role? How active are they? Some of that, Colin, does depend on the industry. If you're in the biotech space, probably less of an emphasis. If you're a consumer-facing company with a lot of sales, direct sales, then certainly that's going to be a higher priority. So part of this is going to be fitting the specific industry that they're underwriting.
Perfect. On the legal side, one thing that companies can do is ask their counsel 12 months in advance for a governance checklist or a set of slides that say, here is the suite of documents that I'm going to need as a public company. Often those can be broken down as a series of decision points. Like, here are the governance decisions that you're going to need to think about and make. And I think you should also ask your law firm for a set of slides or some sort of summary on board independence requirements. That'll show you, hey, here's what you need. Here's when you need it. To Mark's point, there are some phase-in rules that give you some time to ramp. Understanding what those are so that you can have those top of mind as you think about recruiting candidates, and also think about some of those key governance decisions, because they may come into play if you're doing a late-stage growth financing, for example. And it may modify how you think about marking up certain documents, whether it's a market standoff provision in your financing documents or otherwise. Transitioning a bit here to deal uncertainty and deal timing. The market has been volatile, and that means timelines are shifting and changing. And when timelines shift or change in the IPO process, that means you need to take a hard look at your financial statements. Are they stale? And by stale, meaning they need to be as of a certain date in order for the SEC to declare your registration statement effective. This effectively means you need to constantly look at and update your financial statements. And in this challenging environment, would love to get Katie's feedback on what some of her suggestions are for navigating this uncertainty and working with the company's auditors to make sure that the financial statements are ready when they need to be ready, and how to plan for some of this uncertainty.
Yeah. I'm someone who always looks for the silver lining. Here, this just gives you the chance to operate for a longer period as a public company and make sure that you're ready when that IPO flips and you're declared public. And so I think during this timing of uncertainty, I think you do operate like a public company. And what do I mean by that? You do timely quarterly reviews, and so that you are updating that document. And while you're doing those quarterly reviews, I would say also do the practice, making sure you're hitting your targets, as well as the practice dry runs for the analyst calls, or if you're going to do a shareholder letter, go ahead and write those. Make sure that you're even more ready. But timely quarterly reviews, from my perspective, are very important. And then you start looking, in general, 9 months of audited financial statements can equal a year. So if you're coming up on that and you think you're going to need an extra year around that timing, then maybe you do need to take a closer look and get those 9 months of financial statements audited. But at this point, it's going to be a lot of coordination and timing. It's going to be conversations, and probably tough conversations with the bankers. What are they seeing? When are they going to think that you can go? Talking with the company, what price do you want? As well as with your auditors and your law firms, everyone, with respect to what makes sense. Because I get it, it's going to be expensive doing timely quarterly reviews. And it's also not just from a cash perspective, it takes a lot of time away. And so if you're going to have to add in 9 months of audited financial statements to get ready to go, maybe that fourth quarter, start thinking and planning ahead of time, especially that's going to put you with the holidays. And how does that fit in with everything? And so significant amount of coordination and talking. We haven't even talked about flash numbers, right? When you're thinking about getting ready and when are you going to flip? Well, what flash numbers are you going to put in, and how confident is the company with closing with the numbers, as well as with forecasting going out? So think the longer runway you have, and so embrace that right now, and get your ducks in a row, and ensure you're having those tough and really open conversations, looking for the right answer and the truth versus, okay, what can we do, or what do we want to do versus what makes sense.
And Katie, there are some SEC rules that allow issuers to exclude certain financial statements in initial submissions, initial confidential submissions, to the extent that, hey, those financial statements are not going to be in the prospectus at the time that companies go public. I think given the uncertainty, I assume the 2 years in advance is really important, so that you can figure out with your auditors exactly what positions the company best to get audited upfront, what to defer, and how to strategize as to where to spend your resources effectively. Is that fair?
Absolutely, yes. If you're looking at most of the companies who are going to go public under the emerging growth rules, you need 2 years of audited financial statements. And so if you're planning for your IPO, during that first confidential, you don't have to put the 2 current years in. If, let's just say right now, for an example, a company thinks they're going to go in FY24 public, and they want to file an S1 during this next year in FY23, maybe you only put FY22 in that initial S1. And so you're focusing on that. And then at the point that you're going to go public in 24, you'll have your next year FY23. And so you are able to put your resources at the right place and decide how those the work gets allocated. Good point.
Perfect. And the next question is from Mark, and this goes to a comment that was in the chat as well. In a time of uncertainty, managing internal IPO expectations and communications can be especially challenging. One of the things that we see companies do is announce the initial confidential submission. These communications are allowed under certain SEC rules, and they have to be very brief, but they can say, hey, we company have confidentially submitted a registration statement to go public. with the SEC. Do you have any practical guidance, Mark, for folks and executives at companies about employee communications during the IPO process and how exactly you think about transparency in an otherwise sort of heavily regulated process?
Of course, I think it goes back to something Katie said about the tone at the top. We tried to take a very transparent approach to employee communications. We talked about the pros and cons and the risks. And there's so many people that have to get involved in the IPO process. It was very obvious in a lot of ways what was happening. People just knew. It was a little maybe muted because we were remote doing all of our working sessions. So it wasn't quite as obvious that the entire executive team was sitting in a conference room for 12 hours a day, like we maybe would have been. We were sitting in our homes in front of our computers, talking to each other constantly. I think it goes back to your company's culture. I think that the announcing it does put some amount of pressure on it, but I think that there are pros and cons to it, and you have to evaluate what kind of message you want to send, how risky is it, and how to make sure that your company appreciates that the CEO is going to be distracted and who's going to jump in and make sure that customers get taken care of, or make sure the product team understands where the direction is, or there are things that around those executives that need to be appreciated. And I think for us, being more transparent was the way we went, but it's not for everyone.
And Mike, maybe you could speak briefly about how timing changes impact the D&O insurance process and pricing.
Sure. So it's important to integrate, I think, with anything in good kind of best practices, integrating the D&O process into the IPO process. So what we recommend to our clients is let us know ahead of time of filing that first confidential S1. It allows us as your broker because the insurance underwriters, they need to see that. That's their underwriting document. The good news is you don't have to complete applications, but they need that underwriting document. So what that allows us to do is most companies are looking at about a 90-day window from the S1 confidential filing to the IPO transaction itself. So understanding what that timeline looks like and integrating a process that allows enough time to run through a process. The key points are, one, to get that S1 circulated to the carriers. Once that is filed confidentially, we want to get NDAs in place, and we have a process for that with all of our insurance carriers. The second key thing is getting on the phone, and we recommend the management teams of our clients to get on the phone with the insurance carriers. And it's a very similar call to the investor presentations that they do with the testing the waters presentations called the TTW. We can often use and leverage the work that's already being done. So this is not a heavy lift, but it's a time commitment from senior management to have a call with a large group of underwriters and really leveraging that. Doing those things in advance or on time allows us to provide options and present to the board well before the roadshow and well before the company goes public. The roadshow is like the mad dash at the end. And so having this process done and ready to go, and keep in mind, you're not buying this insurance. I mentioned it's very expensive. You're not buying it if you don't go. And if there is a delay, we are in an environment where rates are starting to improve. If there is a long period of delay, let's say you were planning to go on April 1 and July 1, now that you're really looking, now it's looking like you're really going to go, have a conversation with your broker, make sure, is the pricing that they represented to the board, is that still market competitive from today's standards? Colin, I don't know if you were going to look at some of the Q&A, but I could address just one or two questions on litigation trends if you'd like, or I could wait till the end.
Yeah, please go for it.
There was just some questions about SPAC litigation. I think Pierre mentioned on a prior slide, and that's something we track. So keep in mind, de-SPAC transactions are, and I think this is a de-SPAC question, de-SPAC transactions are newer concept. There's been 61 securities class action suits, with about 53 of those coming in the last 2 years, 2021 and 2022 so far through Q3. So we're in early days of seeing The average time from suit to settlement is around 3 to 4 years. So it takes a while to really understand the impact that securities litigation is going to have in this particular area. We have seen some dismissals. We've seen a couple of settlements, but for the large part, it's still an unknown. Are these just kind of hassle and nuisance cases, or there are some with materiality? We've definitely seen some on the material side when we look at SEC fines paid by some companies. So I just wanted to address that. And then there was a question about I think it was insurance carriers look at D&O litigation and litigation trends. And if you're insuring directors and officers coverage and you're an insurance carrier, you absolutely got to pay attention to the trends. They're watching the industries that are being sued, the various market cap ranges that are being sued. They're looking specifically whether the common allegations. They look at also from time to suit to settlement, and they're also monitoring what are the costs of what are the defense costs. So we have a lot of this data that we share with clients as part of the preparation of going public as well.
Perfect. Thank you, Mike. So we're going to do a quick bit of takeaways. We're going to go around the panel and see if anyone's got final high-level thoughts, and then we'll transition and run through any Q&A that we can get through in our remaining time. So Mark, how about I start with you? Any key takeaways just from the IPO planning process that you'd share with the group?
One thing I think, Colin, I'd like to mention that we haven't talked about is the analyst relationship. I think I certainly underappreciated or wish I had invested more time in getting to know the analysts that could potentially cover our stock post-IPO. The bankers are important, of course, but I think that investing in those analyst relationships upfront can help you understanding what reports, what other companies they cover, what the reports say, what would coverage look like for you, and investing in developing a relationship with some of those analysts even before the IPO, I think is, and we work with counsel, of course, as you're having those conversations, but I think investing in those relationships to the extent that you can is a worthwhile endeavor. I think that overall, I just reiterate what I said at the beginning, kind of like no one size fits all. IPO is not for everyone. It's just one of the potential exits you could have. And understanding what you're getting yourself into, what the risks are, what the pros and cons, what the expenses are, can be shocking to some as they work their way through this the first, even second time. So surround yourself with trusted advisors and build a team that's going to help you work through whatever the issue du jour is.
Thank you, Mark. Katie, how about you? Key takeaways?
Yeah, key takeaway. I think the old saying, an ounce of prevention is worth a pound of cure. Get ready. It's gonna take a while. The more you can be prepared in advance is critical. And I'll go back, the tone at the top, starting from the CEO on down as to the transparency and what is important, and moving forward, I think is key.
Mike, how about you?
I think it's process and planning. Think of the things that you need to do early on, have a process in place, and also make sure that the team that you have is the right team and with the right experience. There's a consideration of you need to like the team and feel like you have a good communication and you feel their style implements well, but you also want to make sure they have the qualifications as well.
Great. Thank you, everyone. We are going to transition quickly to answering a few questions in the chat that we can get through. One of the questions was about an audit and what type of audit is necessary to go public. And so there is the typical private company audit plus the PCAOB audit, and I will kick it to Katie if she'd be willing to chime in on that question.
Sounds good. Yes. There are two standards out there. The private company follows AICPA auditing standards. Public company follows public company accounting standards, PCAOB. There is a difference with respect to the rigor of audits under both. A PCAOB audit is going to be more rigorous. Specifically, the materiality is going to be lower Then under an AICPA, that means we're going to look at a lot more. And that also means that the score sheet of those audit differences is likely to be longer and bigger if those internal controls aren't in place. Also under a PCAOB audit, we are going to take a closer look at your internal controls and understanding your processes. Simple things. Do you have segregation of duties? So the same person, getting an invoice and paying an invoice isn't the same person reconciling your bank accounts, for example. And so significantly more rigor and time under a PCAOB audit, and that is what is required to go into your S1 document.
Perfect. Thank you, Katie. Next question we are going to tackle is, when is the best time to announce publicly the IPO of the company after the prep period? And I can field this from the legal perspective. There are, I think, number one advice is talk to your lawyers about the guardrails about IPO communications. There are some fairly strict rules about what you can say publicly about the IPO and when you can say it. And even when you're allowed to communicate, what can go into those announcements is quite limited, and it's limited by SEC rules. And so typically the first formal announcement or the first opportunity to announce that you are doing an IPO or planning to do an IPO is after the initial confidential submission. And there are a number of examples out there from recent technology companies in the 2022-2021 timeframe where they simply say, XYZ company announces the initial confidential submission of a registration statement. And there are typically 2 sentences that basically say timing is uncertain, and a deal will be made pursuant to a prospectus that meets SEC requirements. And this is about all that you can say. And the next announcement, typically publicly, is the public filing of the registration statement. And that happens some months after that initial confidential submission, and you're most of the way through the IPO process. But on communications generally, if you do announce, hey, we did a confidential initial submission, I think you should consider what are the implications of that announcement. Do you get all of your employees extremely excited and expecting to do an IPO on a certain timeline, such that if it's a time of volatility or uncertainty or timing is just not super clear, you're going to have the pressure of all your employees saying, hey, when is this getting done? And that's going to be top of mind in all of those townhouse meetings that you're going to have as a company. Let's see. Next question was, what are some of the key human resources components and items that you recommend in planning an IPO? Mark, maybe I'll kick it to you. Are there certain HR or compensation processes? Maybe you can speak a bit about just the compensation consultant interactions that you guys use in a pre-IPO setting.
Exactly. You're going to want to engage a compensation consultant to look at your peer group. And there's some justification you need to provide around board compensation and employee compensation and your compensation of your leaders. Some companies will do a series of grants prior to their IPO to lock up executives or others, key employees, for some period of time with longer grants or performance-based grants, with stock price triggers or performance triggers, which of course you want to talk to your accountants about. Those are going to be, the valuation of those can be super complicated. But building out the infrastructure for comp generally is something that I really is worth investing in. And then to your point, Colin, earlier about equity, aligning up, doing an audit of your historical equity program, understanding who owns what, do they understand the rules? Is there any changes to the plan you need to make prior to an IPO? How are you going to refresh grants? How are you going to refresh the pool? All those, how do you think about dilution going forward? All those things need to be factored in, and building out your, not only the compensation arm of HR, but also the communication and the manager training. I mean, you need managers on the front lines answering questions with employees. And we tried to invest in manager training so that we could sort of leverage, everything didn't have to come directly from the C-suite. So we made some investments in manager training that I think hopefully paid off.
Perfect. That's super helpful. And to the point earlier that we talked about that the IPO is the replumbing of corporate governance. It's not unusual to put your executive officers on a new form of offer letter, for example, and to put in place severance and change of control agreements. That's all fairly common. And as part of the IPO prep process, making sure that you're taking a look at things like employee classification. Is your employee handbook up to date? All things that an underwriter's counsel is going to get on the phone with you and say, hey, are you buttoned up in these areas? So the hope is that you use the 12 months in advance of an IPO to really work with your own counsel to make sure that you're being asked the questions. What are the underwriters going to look at? What is best practice here? It's a chance to just sort of overhaul and take a deep look at some of your employee facing and HR documents. All right, next question that we've got.
Really help you. Hey, Colin, it can really help you on the D&O front, to Michael's point. Like
Okay.
it's you're pitching your company to your bankers, to your analysts, to your employees. You're also pitching it to underwriters for your D&O, underwriters for the company, the bankers that are the bankers' lawyers. Everybody's looking for risks in the company and understanding where that exposure is and how you can help mitigate it and at least demonstrate that you've thought about it is something that can be very powerful and impactful.
We have another question just about how underwriters view ongoing litigation or the impact of that litigation. Mike, maybe I'll kick that to you from a D&O insurance perspective.
Sure, and there's two schools of thought on this. If you're the carrier that was already on the risk, they had litigation, they're going to be interested in knowing where do we sit in that framework. They'll want to look at, of course, what's the deductible. They'll want to understand who's the legal team that has been hired. Remember, the carriers have to approve the legal team. Wilson Sonsini is one of the top firms. They're on AIG's panel counsel. AIG is one of the few firms that has a panel counsel requirement. So understand, if you're with AIG, one of the largest insurance carriers, there's going to be a requirement that you work within that panel. If you're the incumbent carrier, the carrier that has a litigation, they're going to want to just understand where you are in the process. I made a comment earlier that to get to a motion to dismiss, where you find out, is this going to be dismissed or are you going to be in settlement talks? I think it's these days a minimum of 12 months, potentially more like 18 months. And Colin, you can add in your 2 cents if that time frame makes sense. And so they're concerned, the carriers are now more concerned about their limit being exposed and potentially paying into a settlement. So understanding where they are in the process. At the same time, we're going to see litigation. They're insuring something that they know is going to happen with some companies. If you're a carrier that is not on the program, so that's the pessimistic viewpoint. The optimistic viewpoint is if you're a carrier that's not on the program, you start asking yourself, what are these allegations? How recently were they made? And what's the probability of a separate, unrelated securities class action suit to come in the year following, or within the year following, if you've got a renewal in between that, in the year or within the year following that last class action? And it's pretty rare. So I think you'll find in this environment where we have more capacity, more competition, the incumbent carriers are going to be concerned, as you would expect, and ask questions. They're still going to review the risk and want to be competitive in keeping the relationship. But then the carriers that are not on the risk are going to be potentially looking at, if I like everything else, if I like the operations, the company, the management team, if I feel like they're describing what happened adequately and it's just one of those things that happened, and I don't feel like there was downright fraud in the allegations, although they'll allege those, it's pretty rare that I think it occurs, then they may see that as a kind of one of those scenarios where the risk, this has been de-risked, and that therefore get even more competitive. So I think it depends where you're coming from. In short, are you on the program itself, or are you potentially new, looking to win the business with the company?
Perfect. And Mike, while we're on you, there was a question about what actions or inactions D&O insurance does and doesn't protect. Is there anything high level that you can share on that front?
Yeah, these policies are written very broadly. So directors or officers are broadly defined as past, present, and future. So there's not an obligation of the company to continuously notify the carriers as people are coming and leaving the organization. As we think about it as a public company, the highest frequency and the highest severity are securities class actions. So these are breach of the fiduciary duty obligations of directors and officers in their capacity as a director or officer for allegations that are going to be securities related. You reference, I'll pick on Mark. Mark makes a projection about earnings forecast, and you made these projections, and now you're telling us on the next quarter we didn't hit those. I'm not saying that happened, Mark, but I'm just saying is picking on the CFO in the room here. So these are the people that are most commonly going to be named are the CEO and the CFO. And why? They're the ones certifying financials. So if you had a financial restatement, they're the ones often talking to investors and making forward-looking statements. So those are the ones most at risk. We'll see also the chair of the audit committee. And board members have exposure, but the two most common people named are going to be those officers of the company. Colin, you want to add anything to that? I know you maybe dabble with this in terms of adding any more color to that.
No, I think that's super helpful. I think we're going to get to the last question here. We're running out of time, which is, how does the IPO planning process get reported to employees, and what can be reported and what is best practice? And I think this goes to a sentiment that you've heard throughout this conversation, which is this is not one size fits all, and you need to do what's right for your own organization. I think typically what happens and what we see is there is a key group or a key working group internally that is sort of over the wall, as we say, meaning they understand what is going to happen and they are participating in the process. To Mark's earlier point, you need to get information from throughout the organization. That's finance, HR, IR, legal. And so certain people are just going to need to understand that the transaction is happening and that we're proceeding towards it. You typically bring those people in advance so they understand, here's what's going to happen. Here's what we expect from you. In part because these folks have a day job, right? They need to budget this time and they need to help prioritize. And I think having these people and setting expectations at the beginning of the process is extremely helpful. Mark, I don't know if you've got any other feedback on the point, just in terms of when to bring people into the process or how to communicate with them.
We always talk to counsel first, because like you said earlier, there's just a limited number of things, and the scope and scale of those things, depending on where you are in the process, can depend on what you can and cannot talk about. With with customers, with prospects, with existing shareholders, with your employees. So I would say that outright. And then we tried to be as transparent as we could. That was our culture. Is our culture to be transparent about the risks and potential rewards of anything we're doing, a product investment or an IPO included. Yeah. So I would just say, like, think about your company and your culture, and think about your counsel and what you're allowed to say. Don't have that impact your IPO timing.
Yeah. And I think one thing you can do on communications generally is just connect with your counsel to talk through an IPO communications roadmap and process. Any sort of written communications that go out, especially anything that mentions an IPO, should run through counsel, and it will need to be reviewed by not only your own counsel, but underwriters counsel. So making sure that as you think about IPO communications, and even just communications during the IPO process. So if your CEO is set up to speak at a conference, for example, making sure that the lawyers understand what that conference is about and that appearance has been vetted and people understand the ground rules is going to be an important part. So having an IPO communications plan and key people within the organization and externally that help coordinate that process is just a key part of the IPO timeline. And with that, I think we are out of time.
Awesome. Well, Colin, Mark, Katie, Mike, thank you so much for sharing your insights and your contribution to this panel today. We really appreciate it. And for everyone still on, if you're interested in booking a meeting or learning more from our partners, we're going to follow up with contact information. And also, we've got a link in the chat to give us some feedback and raise your hand if you want to meet with our partners. But Colin, Mark, Katie, Mike, thanks so much. For those still on, we have another panel up, Executing Your IPO. So please take this time to refill your coffee cups. Take a quick break. We're going to return shortly. See you in a second.
Thanks, everyone.
Thanks. All right, all right. Welcome back, everyone. Next up, we have our panel of experts to share on how to execute your IPO. Friendly reminder, we're going to open up for live Q&A near the end of the panel, so please submit those questions for us in the Q&A function at the bottom of your screen throughout the presentation. Before we jump into our panel, hi Shalu, we're going to launch a quick poll just to let us know in the next 12 to 18 months, how many of you are planning on starting the IPO process. So headed in that direction, yes, but not within that time frame, or not quite yet. Thanks for your responses here. This will help guide our discussion for this panel. Appreciate you responding. I'm going to let this roll a little longer. All right, looks like it's a pretty clean split between not quite yet and yes, but not within that time frame, and headed in that direction. So thank you for participating. All righty. Well, I'm going to stop that poll and share those results with you all. Looks like not quite yet is the top of the key, and this tis a slow season right now, as we've been talking about. So it looks like there are some headed in that direction. Again, nothing like a quiet desk to be more prepared, and yes, but not within that time frame. All right, thank you all for participating. As mentioned, up next, this next panel is going to cover executing our the IPO, and we're waiting on our moderator for a second, but I'll introduce our expert panelists joining us. First off, we've got Shalu Garg, who is a managing director of late stage startups at Microsoft, and Troy Egelzi, a CFO at Karuna Therapeutics. Welcome, welcome. Oh, and we've got Jagani just popped on, and we have our moderator, who's the head of US listings at Nasdaq. Welcome, team.
Thank you. Great to be here.
Looking forward to this. Jack, over to you.
Thanks so much, Colin. Great to see everybody. To kick things off, I'll just as Colin had mentioned, my name is Jack Castle, and in my role, I have the pleasure of running Nasdaq's IPO business for North America and EMA, and getting to work with so many incredible companies as they hit a few milestones that we'll discuss today and start to target that transition from the private markets to the public markets, which is a big step. And so you'll hear from Shalu and Troy, who have incredible knowledge and experience in this path, and a lot of what it takes to be successful. Again, not only for the entrepreneurs and the executives listening, but as you start to look towards the public markets and what it takes to have a lasting Hall of Fame career, if you will, to use my sports analogies. So with that, I'm going to have you both introduce yourself, and then we'll jump into some Q&A here, if that works. So Shalu, I'm going to turn it over to you first, please.
Great. Thank you, Jack. Hey, everyone. Great to be here. Good to see you all. My name is Shalu Garg, and I am currently with Microsoft. I lead the pre-IPO and the IPO business in terms of strategic partnerships. Have been with Microsoft for about 4 years, just doing tons of interesting stuff around startups. I was actually recruited in 2019 to lead the early stage business, and then went on to build this new business around pre-IPO and IPO. Prior to that, I've spent many years at Oracle around mergers and acquisitions. Have acquired about 24 application acquisitions, including the integration business, and then also co-founded the startup business at Oracle. Outside of Microsoft, I am on the board for UN Women, where we constantly bring the conversation around technology into our daily lives and see how we can get more creative, more innovative, and more efficient in terms of driving not just our business, but our personal lives as well. So super excited to be here, and I'm so looking forward to this conversation. Troy?
Thanks, Shalu, and I would thank Nasdaq and Jack for having us on. It's a pretty exciting panel. Troy Egelzi, I'm currently the Chief Financial Officer at Karuna Therapeutics. Throughout my career, I've helped 8 companies, either as a employee, heading up finance, various roles there, or as an advisor through the IPO process. One as recently as January of this year, where I'm on the board of Syncor Therapeutics, who did go public. I will say all of my background and most of the feedback that I will give to the group today is going to be around work that I've done in the biotech community, because that's where I've worked. But I think most of the learnings, with exception of the pace, some of the things that Shalu is working, I'm sure the pace is much faster than what it takes in the biotech arena. But I've helped raise about $4 billion, public and private, used the Nasdaq across every one of the IPOs that I've done, and they've been a great partner for the companies that I've worked with. So thanks again for the time today, and look forward to a great discussion.
Great. Thank you both very much. And Troy, I do have to call out also, I believe you executed one of the largest follow-ons as well. So that's another feather in the cap.
Yes. Thank you. We had the largest follow-on of the year and the third largest ever in biotech. We'll get a little bit to how an IPO is a big version of a follow-on, and the importance. I've done a couple follow-ons within less than 4 months of an IPO, and it's all part of the preparation of the IPO. Because I think one of the things we'll want to talk about is what it's like as you get there, and how to be really prepared for the next steps. I know there's another panel that'll talk about life as a public company, but what you do before ensures that you're capable to be a public company.
Yeah, love it. A lot of just prep, right? Just be ready. And so maybe we'll start with that. So 2022 has been a slower year for IPOs. I remember sitting in this seat a year ago, and all of us, having to find bigger snorkels to keep our head above water, given the volume. And so this year has been slower, a lot driven by investor demand, yet we see a very strong backlog of companies waiting for this window to reopen, whether they're on file confidentially or the board's kind of given them that mandate to be ready. We're excited for this next cohort and group of companies coming to market. So maybe just to kind of tee this up, when it does reopen, we do expect to see, again, a good group of companies access the public markets via the traditional IPO, but there's other ways to access the markets through direct listings, SPAC combinations, or even reverse mergers. So Troy, I'm going to throw it back to you. Given the experience you've had and just shared on advising several companies through this, and then of course with Karuna choosing the traditional path, how do you view these alternative options, and how should executives and teams be thinking about them?
Well, I was fortunate enough, as I mentioned, we did get the Syncor IPO out this year, and it's been one of the few. As you mentioned, it's been a relatively quiet year by the recent IPO standards, but I don't think it changes regardless of the overall environment. And when I'm sitting in that seat as an executive, in particular, I think the CEO and CFOs, your job is to maintain as much optionality as possible, meaning the work that you do to prepare for any one of those options, Jack, that you mentioned, doesn't change a lot. We'll get into some of the details, but the accounting systems that you put into place, the HR systems, the type of team that you're building, and the work that you do, it transcends all of those options. For example, in a reverse merger or a SPAC, you're still submitting the equivalent of an S1 as you're trying to do this combination along the way. So you need to have the right legal support, again, the right accounting support, and build your team accordingly. So what I always say is, rather than make a predetermined notion or where you think you're going to go, be prepared for all of them. And then the market often will dictate which one you end up in. Typically when the traditional market is a little bit tougher, it's usually because, there's been a downturn in the economy, or there's been a tough time. So what that means is there are companies that are underfinanced, which creates a reverse merger target. SPACs kind of came forward as a way to, in my mind, do a reverse merger without the baggage of the company that may have failed or struggled along the way. So it created the direct listings is one. I think that if you've got the right following, I do think that of the ones that are available, that one may be a little bit more challenging in the after IPO process, because you don't get the momentum of building the capital like you do. You don't get necessarily the bank coverage that you might want. It's a little bit harder as far as the after market goes, if you will, the after IPO process. But it's still one to consider. Again, all of them require the same prep. So don't necessarily make a choice. You'll be driven a little bit by the market. And I will say at least two of the ones that I've been completed under a traditional IPO, we were very close to executing on a reverse merger in both of those. One was back in 2008. Everyone knows how challenging the markets were in 2008 or 9. So that created, I think, a lot of the reverse merger market. It became a lot heavier in those years. And another one more recently, again, in an economic downturn. But we were prepared and we're the last ones at the table, if you will, negotiating reverse merger. And nothing was different. As I went to the traditional path, it was still presenting to investors, presenting to board members, building the organization.
Yeah, that's well said. And I think, again, a lot of it is there's a lot of the building blocks and the foundational work that can be done that gives you that optionality. And Shall, kind of going to you, as you're looking at the later stage companies and engaging there, they're typically coming to you for advice around this as well. What are your perspectives on these different paths, and how do you kind of distinctly define those and what's right for companies?
Yeah, absolutely. So in my daily role, I mean, 90% of the time that I spend is basically working with the C-suite or board of directors to solve for this. When do I go IPO? I want to go IPO. Is IPO the right path, right? And so 3 things top of mind. I think Troy did a pretty good job kind of summarizing it, but I'll just touch on a few things. Number one is not everyone will be able to directly go in a traditional IPO. It's not meant for everyone. It's not like it's almost like one size does not fit everyone. And so going public, and this is one of the advice that I give to the C-suite that I work with, is going public is an extensive transformational process for any private company. It's not just looking cool at Nasdaq and being listed in the stock exchange. I mean, it's a complete transformational process. And so be ready for that. One that requires a change in the mindset of the company's executives as well as employees as they prepare to operate for benefit of the widest shareholders. It's no longer going to be that small little company, even though it may be 1,000+ employee company. It's not going to be that. So be prepared and ask yourself, why do you want to go public? And that's a question only you can answer for yourself. It's not just, a competitor was listed, the market is good, I'm going to be $1 billion+ rich. No, why go public? Ask that. Number 2 would be SPACs, in my opinion. So I've had pretty interesting use cases. I've worked with quite a few startups, and I will refrain from mentioning the startup's name, but this startup that I worked with last year was in the automotive space, raised about $300 million in SPAC. The CTO reached out to me and said, hey, I want to just transform my company. I want to start treating it like an enterprise company because that's where we are headed. That's where we want to go. And, I want to have this conversation with you in terms of technology. And the first question that I asked him was, do you have enough cash runway? Because the $300 million check lands with you over a period of time and you just get ready to spend it, right? And so in my view, it's a risky path. And again, it's meant for some, it's not meant for others. But I will say that SPACs are more accessible to regular individual investors, and they're generally considered less transparent than traditional IPOs. To Troy's point, the process is the same. At the end of the day, all the paperwork all the due diligence has to go through the same path. But where it lands is extremely speculative. And the last point that I'll make, but definitely not the least, is do your homework. IPO versus SPACs, it can be speculative, it can be risky investments. Headlines about your company on LinkedIn or news media is very important, but it's very, very critical not to get swept away by all the investments. I'm sorry, all the excitement and all that comes with it. There is no guaranteed return. I think we are all seeing it in this market, which is extremely volatile and unpredictable. So do your homework and see what best fits for you and your shareholders.
Yeah, sound advice. I'm glad we're recording this. Over the last few quarters, you mentioned the volatility in the market, and some of the consequences of that volatility are companies' market caps or valuations have started to depress a bit. We were coming off all-time highs there over the last 18 months, or call it 2020 through 2021. but they have quickly changed over the last few quarters. So Troy, I'm going to start with you on this one. What is your mindset around valuations and or the key metrics to track there?
So, I would look at three different ways, if you will, to calculate valuation or triangulate into where you should be targeting. And one is the last round. And this is where, Jack, your point about the current market kind of compromises that particular input, right? Is if the market's been going down and you just took up an up round, but yet you've got some challenges, you're going to have to discount that evaluation of it. And we'll come back to really, I think, how that ends up working. The second is you're going to look across your peers. Where were they valued at, consistent times, or, with where you're at in the development in our, world of biotech, what stage of development, phase 1, phase 2, phase 3, whether or not you've got an asset that's in a very large market, or if it's more narrow. And then third, you're going to look to where you think the interest lies. And I think that was, I've done IPOs pre-Jobs Act. So that tells you a little bit how long I've been doing this. And then post-Jobs Act with the test the water meetings, you really do get some good feedback from the market. And they typically are looking for some multiple to your last round. But again, if your last round is compromised, you have to be willing to take that into account. So I think what really ends up happening, again, in the IPO valuation process, has a lot to do with the investors that you have in the company leading up to. And again, I don't track the other industries as closely, but in the biotech, you typically have a mezzanine or a crossover round, which brings in some quasi-institutional investors or groups that are hybrid that can do both. And you find yourself with institutional investors helping you set the price there and typically participating in the IPO. Now, if your last private round overlaps an economic situation like we've been in, it does create a bit of a conundrum. And I think that's frankly one of the reasons we've seen less IPOs. There's still good companies out there. There's still investors that have a lot of cash and want to put it to work. But do you necessarily want to go into the public market and have to take either a flat round or even a down round just because that's what you have to do? This goes to, I think Shalou made some really important points. When you're planning to go public, never assume it's going to happen. I was with one company, we got our SEC approval in 2007. The company didn't go public till 2013. So just because you get through all of those hurdles, and I'll talk a little bit more when we get to some of the questions about what that process and the team to do it. But you should always make sure that you've got cash in the company, not targeting a certain date, because you don't know what the macro environment's going to be. You might think we're going to close this round, we're going public in June. If I had $1 for every company that was asking me to help them get ready to go public in 2022, I probably wouldn't have to work today still. There were a lot of companies, which is what was encouraging to Colin's survey that he did. I think companies are being a little bit more realistic about their timelines. You don't necessarily get to dictate when that is. You have to be prepared. You have to be prepared for changes in valuations. And you have to be lining up your inflection points. You don't want to go public and be 3 years away from your next value creation opportunity, or, in other industries, if you're too far away from revenue, if you've got a product that you think you're going to be able to launch, if you're too far from revenue, too far from break even, you have to really plan and line up how that works as you're going to be a public company, because that's that becomes your currency to try to, keep the company capitalized. And that goes to your point. We've done 4 follow-ons since we went public in 2019, one of them within 5 months of the IPO. Your company has to be prepared, and you have to know where your milestones are lining up and where the company is. Now, if you are close to a milestone that could be meaningful and have a value inflection, you might be willing to do a flat IPO. This goes back to your initial question on valuation. It just has to do with where you think that next inflection point is going to be, where you can create value for investors.
Yeah, well said, Troy. And Shalou, I do want to come to you on this as well, and dealing with the later stage companies, because I think you nailed it, obviously. And as Troy articulated, you need that runway, you need to have that plan. But as we also know, especially in this market with some of the recent rounds, there are optics around the down round or the valuation and what's that company, what that value is. So maybe walk us through your sentiment on these exercises and how you advise private companies.
Absolutely. So before I answer the question, let's get to the basics. Valuation, what is it? It's a quantitative process, really smart geeks sitting in a room. It's a process that determines a fair value of an asset, investment, or a firm. It's a fair market value, right? So nobody has the authority to say, oh my God, like you're worth $1 billion, but you're worth 500 million. Nobody has. I mean, it's a complete process that one has to go through. So a company can be valued on its own, on an absolute basis, or to Troy's point, a relative basis compared to other similar companies in that ecosystem. So if you're talking about biotech, well, today, if my valuation is 4 billion, maybe Troy's company is 6 billion. And that's because those are the parameters and the facets that we are looking at. So a lot of math that goes in valuation. I will tell you, sitting where we are in Silicon Valley, it is a rat race when it comes to valuation. And it's often scary because our minds are tuned to look at companies. And the first thing I'll tell you, the way I work, when I look for a company, the first thing I go is ARR, what's the valuation? And that is kind of unfair because a similar business model sitting in Silicon Valley could be sitting in Amsterdam, Dubai, South Africa, Singapore, right? Since we have global audience, so let's bring that up, could have significantly lower valuation, but equally good in its value proposition or filling a gap in the market. And so my guidance to the C-suite team that I work with is don't get too overexcited. I mean, look at what has happened to valuation this year. I wish I could name companies. It is very disheartening to see companies who went IPO last year are now not only having talent attrition in the company, but are not even, I mean, their stock prices are like 80% down. So it is extremely important, especially as you're getting closer to an IPO or whatever process you want to follow, is be humble. Be humble about what you have and where you can go. Focus on the journey and not on the destination. That, man, I want to be really rich one day, or I want to be known as the top player in the market. I want to be like the top valuation company. And a lot of companies, unfortunately, do that. And I've seen companies unfortunately fail. And so it's very important to be humble and grounded, be immersed in the math, know your stuff really well, in and out. The second point that I really want to make, which Troy addressed, was being cash rich. At the end of the day, cash is the king, right? As you're pulling the SEC documents, one of the things that is top most important is cash in the bank. I mean, I'm right now involved in a deal that's pretty significant. It's Series A funding. And we were looking at the balance sheets. We were going through some due diligence. And one of the things that was a major stickler point in that conversation was they don't even have cash in the bank. Yet they're raising like $40 million. Will they even be able to recover? Right? So it's a combination of a lot of things that play. Sorry.
No, I was agreeing. I was not interjecting.
Yeah, and so that's equally important. Is, you know, cash in the bank is a must, and not being complacent with cash in the bank is also a must. So if you have a good cash flow, fantastic, good for you. We're really happy for you, but keep that going. Don't stop, and come up with creative ways in how you can show up in the market constantly and frequently.
Yeah. So this panel is certainly about executing your IPO, but I think we'd be remiss if we didn't also mention M&A as an exit opportunity for companies, especially given today's environment and what we just discussed. So Shalu, I'm going to throw it back to you from your seat. Are there certain sectors where you would expect to see increased M&A activity in 2023?
Absolutely. I think consolidation will be the name of the game in year 2023, 24, and 25, next 3 years. I mean, we will still be recovering from the bruises that we have got this year, and will continue to get in year 2023. 2023 is going to be a rough year. I think all of us know that, with inflation, recession, strong signs of recession, GDP overall. The top sectors where I see good amount of consolidation happening is fintech. Fintech is very prone, very vulnerable to consolidation, which is good because there are a lot of, I would say, business models that are out there that can easily be absorbed by big companies and still do really well. The other is the health tech space. These are evergreen industries. And then third is retail. And the reason I say retail is because retail is heavily exposed to the metaverse and the Web3. So most of the conversations around Web3 and metaverse are actually happening in the retail sector. Like H&M is already there, Gucci is already there. These are like public brands. And so there are more conversations happening that as we see more deal flow of early stage companies coming into the market, which is fantastic because we all want to see good innovation. How can the activity of consolidation when it comes to M&A happen? And M&A in long term can actually be fruitful. And I've personally been involved in around 24 odd acquisitions. I would say an integration strategy is a must to any acquisition success. I don't know if we are there yet when it comes to sectors like metaverse and Web3. How is the integration going to happen? Because we are all trying to figure that out. Like nobody is a leader in that space yet. Maybe next year we do have one. But those, I think, are good prone sectors where a lot of conversations around consolidation is going to happen. And it's great. I'll make one last point. The reason it's great is because we do not want the big players to continue monopolizing the market. So we want to make sure that we have an open innovation system where we are bringing more and more startups in front of more enterprise customers, more SMB customers, to give them a choice of solution that they want to go for.
Yeah, that's well said. And I think, as I put on my investment banking hat or M&A. I was, before joining 5 years ago here at Nasdaq, I was an M&A banker for a number of years. And I think for the entrepreneur and for the executive team, that still can be an attractive path, as you highlighted, that allows you, with the right strategic partner, you're still able to build your business and scale. And with some of those shared resources or the go-to-market, even still attain your objectives and your vision for the company. So it doesn't necessarily mean it stops there and IPO or nothing else, right? You can still be a very successful part of a larger incumbent or broader enterprise.
Absolutely.
So transitioning a bit from that to the themes around timing and preparedness, kind of picking up on that theme, it seems like companies again, over the last few years have really accelerated to hit this window. I know we're in a bit of a pause now, but as we think of preparedness, and Troy, I know you touched upon this a bit, but what can companies be doing to ensure they're prepared? And maybe a follow-on to that, or what sacrifices are typically made in the pursuit of speed, and are those worth it?
Yeah, I think if you're prepared, that second part kind of takes care of itself, as you can go fast. I've actually gone from, kicking off to filing the S1 in about 75 days before. But that was because we were prepared, So yeah. It starts with simple systems within the company, probably, at least as a recovering accountant, if you will. The most important is accounting systems, PCAOB, audited financials, from the, as soon as the company started. They're not that much more expensive from an audit. And you want to get a reputable audit firm who has experience with, taking companies public and managing them, being your audit partner when they are public. So I think it starts there. Good legal advice, setting up the company in such a way, setting up all of your early financings in such a way that it's easier to get public. And what I mean by that is not encumbering, your balance sheet or your cap table in ways that make the IPO process more cumbersome, makes disclosure harder. So you want to make sure you've got a good legal partner, a good accounting partner. In my mind, and those are both external resources. They don't create an additional burden on the the operations, the daily operations of a small startup company. No matter what, you're going to have somebody doing your accounting and your accounts payable. You're going to have someone hopefully managing HR and payroll. That can even be an outside resource, but you want to have partners in place that allow you. I saw one of the comments in the chat is you absolutely should be looking forward 1 year, 2 year, and I encourage all the people that I work with to do this in your own personal career. Act today to where you want to be tomorrow. Act today as a company to where you want to be tomorrow. Going back to my initial thing though, is make sure you're maintaining as much optionality as possible. Because as Shalou pointed out in the follow-up to my first question is some things, whether it's the market environment, whether it's where your specific space is going, some of these options might not be right for you. They might switch what's right for you at any given moment, given factors you can't control. So control the things you can, and that's by building the right external team. I would say from an internal perspective, at least for me, I've always wanted a good internal accountant or somebody that I could count on the books. Even though I'm getting them audited by a good firm, I want those books to be in such a way that transition and the ability to get underwriter support, both counsel and banking is so much easier and seamless. And I think this is something we'll talk about a little bit later as well, but you want to start establishing good banking relationships. They're a partner in the process. And that includes the bank itself, but also looking to the analyst that you're gonna get a chance to work with, hopefully, as you go forward, because it should be a choice by both parties. And you've got to get your board ready. I think Shalou said it really well. I actually remember the very first IPO I did, we went through the pros and cons. Do you even want to be public? And it was kind of a scary and daunting task when you start thinking about the requirements and the responsibility, the ramifications, from a legal perspective. I know we talked D&O in the previous group, but there's a lot of responsibility that comes with it. So you want to prepare everybody around the table for that process. The employees that you do have, as you start working that way, there's a discretion level that's required more of a company that's about to go public or is public than when you're private. So I think it's all about making sure that you're building the team as if this is where we're going to be in 6 months, 9 months, 18 months. It's okay to do some of that stuff today. And as I said, it's not that much more expensive to have a good top 5 law firm. It's not that much more expensive to have PCAOB audited financials from the get-go, because recreating your financials, if you're trying to do something, is hard. And then trying to keep your capital structure as clean as possible, thinking about the required disclosures as you go forward.
Oh, great stuff. Shalou, kind of sticking with that, but we've seen a few recent cases of companies lacking proper corporate governance, right?
Yeah.
And some companies, billions of dollars, not even having a board, not to name names. But can you share your view on the need for that corporate governance, and a bit to kind of dovetailing on what Troy shared on when executives should be getting to or begin thinking about having that board public ready?
Absolutely. So I think Troy did an awesome job summarizing kind of pre-IPO readiness, but there are 3 things I want to address, and then we'll get to corporate governance. Number 1 is customer base. Customer base, focus on growing customer base. And it comes back to being cash rich, right? So yes, you feel that you're there, but do you have increased cash and long-term capital to give you that runway? So one of the things that we focus on more is what's your go-to-market strategy, both pre and post-IPO. So it's not just going IPO and then, what's your post-IPO plan as well to continue that momentum. So I personally tend to focus more on that, is focus on the big customers, enterprise customers, even though if you have small opportunities here and there, keep that growing, keep the momentum going, keep the sales going, because that at the end of the day is going to show a stronger balance sheet. Number 2 is increase market values. So the value of public companies, they tend to be higher than that of the comparable private companies, and that's partly because of the liquidity and the transparency of the publicly available financial information that's there. Be sure you're ready for that. Number 3 is, which is, often overlooked, but in my books is super critical because I've seen a lot of founders go through this, which is loss of control. And I call that emotional pre-readiness. Think about it. You've given literally birth to this company. You've been with the company. You've seen it grow over a period of 8 to 10 years, sometimes even longer than that. I know founders who have sold their houses and just some crazy stories I can go on and on about. Finally, you have this big day and you're taking the company public. But guess what? You're losing control, right? Not everything is yours. Now you have public shareholders. Now you have a different team, so on and so forth. So be sure that you're mentally prepared to take that on, because oftentimes I've seen founders get very excited and post IPO, like Q2, Q3, year one, they're like, man, why did I do this? I was much more happier before. And not to say everyone is upset, but there are cases where you just have to sit down and talk to them and say, guys, like, this is real stuff. This is life moving forward. So what I call emotional pre-readiness, and I think it's very critical. Coming back to corporate governance, one thing I would say is keep the friends and family out when it comes to board. I've seen a lot of boards where he's my brother and she's my sister, and a lot of family in the board. All that is good, but I have often seen conflicts as well. And by friends and family, I don't mean immediate family. I mean, I've worked with so-and-so years ago, and now he or she is on the board. Do what's right for the company, which means it's okay to say no to your brother or no to your sister. I mean, do the right thing for the company. You can never go wrong if you follow that path. And that's where the concept of corporate governance comes in, which is, are you really doing the right by yourself, by your customers, by your partners, by your shareholders, so on and so forth. And of course, there are legalities or the legal consequences to corporate governance, but that to me is super critical. And to your point, there are a lot of stories out there which we can have long conversations about where things did not go well. And once you kind of double click and see, most of it was relationship based. Someone was seeing somebody or someone was part of somebody's family, and that's okay. I'm not discouraging that. All I'm saying is do what's right for the company. And that is super critical.
Yeah, great. Troy, anything to add there on the corporate governance? I know you kind of weaved in some of the board readiness in your initial answer, but thought I'd see if there's anything to add there.
I think to Shalu's point about getting the right people around, get a strong audit chair, so you have someone in that position, and then also, your nom and governance. You should be looking for people that are seasoned in those roles. But I still do go back to, having the right team from the get-go will help with a lot of that. We actually employ 3 different audit firms across different aspects of our business. Certainly not something you want to do necessarily going into it, but as you get closer to being public, and maybe as you become public, getting extra sets of eyes that are helping you do that, it gives external, I think, parties a little more confidence. When I talk through how we have our internal audit team is actually an external firm that we use. That's one of the top firms, as well as our lead auditor. But then also legal. We're very fortunate to have. I'm very fortunate. I've worked with most of the top firms in the biotech space, and having them intimately involved from the beginning. And I think governance is shared and should be an expectation. The board should be pushing for it, but management, CEO, CFO should be demanding it internally. It does become a culture of compliance and preparedness. And I think that's where it all starts with the internal senior leadership team.
Yeah, well said. And I just add to that, just in where we sit here at NASDAQ and our purview into those that do it well and those that have some areas of improvement. As we've seen this delay in the IPO market, we're seeing a lot more companies focus on this. And we actually offer some governance solutions, but one of our fastest growing now is around board assessments and understanding the strengths and the qualities of your respective board members, and understanding how those actually play well with the other board members, right? So a lot of people are, as we know from hiring, whether it's your lead of sales or CFO to a board member, a lot of people look great on paper, but are they able, from a culture perspective, to really fit what you're trying to create? Are they going to be great advisors? Are they going to help you scale the business as well? Are they going to help tell you no at certain aspects of when it comes to hard decisions in certain aspects of the business? So it's been a
Jack, I do want to add on that, because I think you touched on something that made me think. There's a lot of I think very concerted effort right now in ensuring board diversity, and to me, that's kind of what you're saying, and Shalu alluded to it as well. Getting people around the table that have a diverse background, diverse set of experiences, both culturally and professionally, really helps to ensure that you get that kind of exposure, and you do get people that have the expertise and the personality to be able to ensure that. So it's absolutely, and I know it's another area that NASDAQ has been involved in, along ESG and other DEI reporting, things like that. But it starts again with management. It's part of good, in my mind, it's part of good corporate practice.
Yeah, well said, Troy. So I'm going to stay with this, and I want to come back to a question there, but just kind of going through the process. Troy, this one's for you initially. Just, we've seen a trend of companies meeting with both investors as well as analysts, and you both highlighted the importance there to understand who's going to be covering your name. But we're seeing this sometimes months, even years ahead of an IPO. So I want to just get your perspective on best practices around the timing of engaging both the buy side and the sell side. And is there a minimum or a maximum number of meetings or a cadence ahead of IPO that you would recommend?
Again, my sense is, and I'm sure Shalu will be able to add on to this, my sense is that a little bit depends on the industry. Biotech, as I mentioned, as most of you guys know, has such long lead times to activities. A clinical trial can take 18 months. My sense is if you're spending 18 months working on a new software, it's obsolete by the time you do it, different tech areas. So I think that there are some differences, maybe, and maybe not, but I think identifying the top banks and analysts early on I think it's integral. I mean, some of the banks now are even leading M&A transactions with private companies, because they have the network. They know, especially in times like this, what bigger companies are looking for. Going back to our valuation question, the valuations are ripe for opportunities like that. So I don't think you need to talk to 25 banks. I think you identify the 3 to 5 to 6 or 8 or in your area, in your industry, that are the really good ones. And I would encourage people to look beyond just the bulge banks. I love the bulge banks, but engaging some specialist banks maybe within your area is really important. Having a relationship there, as well as the big bulge banks, is going to pay dividends in the long run. And I think you got to be careful not to try to get in front of them too much. You want to get them in front of them with a cadence to demonstrate things have moved forward. Whether it's you achieved a milestone that you had laid out, or you've shifted, or new information has become available. You want to make sure that your story doesn't get stale with them. You want to keep out in front of them. If there are things happening in your industry that have an impact on you, that's kind of an opportunity for another connection there. I think the same thing is true in the investment community. You know who your top venture private investors are. If you don't, you should work really closely with your bankers to help identify who's really financed a lot of the last private deals. But, you want to also start meeting with those crossover hybrid investors, because they're the ones that are going to give you a sense of whether or not you can really take this company public, and what's going to be meaningful they're going to need to see. You're going to be able to refine your timelines. A good example is Karuna. We went public in June. We read out our for July, I guess it was July, where we were finally effective. The first big data set was the second week of November. Had we gotten much closer to that, the feedback we were getting from investors was, I'll sit this one out. I don't want to get too close to that. I'm pointing out a very simple one that probably most executives appreciate, but you don't want to be too close to that big event and have egg on your face if you put a bunch of money in and it goes public. But we were able to get far enough away from that and establish another milestone or two that could help to recover the company if that were the case. But it helps you to build your story and helps you to build your message by getting in front of those investors that are going to be the ones that are going to tell you whether it's going to work or not. So I think a good cadence, but really using changes in your business, advancement. It's also a way, I wasn't here pre-IPO, but it was interesting. 2 of the meetings we had on the roadshow were investors that had looked at the company 2 years previously, and they said we were planning and preparing for this. It's the exact same timeline that you gave us 2 years ago. It demonstrates execution. It demonstrates that the management team knows what they're doing, knows how to put a plan forward. They said you're using better graphics today to present it, but it's the same thing. So trying to make sure that and if you do find that there are changes, just bridge to those. Let them know why there was a change, but you do want to appreciate that these guys are paying attention, and that matters.
Yeah, absolutely. Shalil, I'm coming back to you because Troy mentioned something around with the diversity on the board, something again that we're very passionate about here, and really around diversity of background, of mindset, and of leadership skills, and how that comes together and is such a quality for successful companies and teams in general. And you've done an incredible amount, a lot of your thought leadership around female-led companies. I'd love to just maybe touch upon your view on that and a bit around the female-led companies or female founders as well.
Absolutely. Thank you for bringing up that question. I really appreciate it. So, it's I can go on and on about some of the numbers that are very, very prominent in the startup space around female founders. The biggest issue that we have is funding. I think we've been talking about it forever, almost tired of talking about it. But one of the things that I have seen, or I recommend to the board that I work with, and it's not necessarily pre-IPO, post-IPO, even early stage founders that I work with, is just taking a company to a specific milestone, no matter where you are in your journey, is not enough. And there are 2 ways to do it. Either you can do it alone, or you can do it with a team, and a team that's built with diversity mindset. And by diversity, I don't necessarily mean gender-based diversity. It could be, someone who's from a different background, someone who comes from a different country. It can be all kind of permutation and combinations that come there. I will say that there, especially in the startup space, there's been significant amount of improvement around giving opportunities to female founders, especially when it comes to funding. But the buck does not stop there. A lot of companies, especially C-levels, talk a lot about being diverse, but they don't walk the talk. So diversity doesn't mean, hey, I've hired a female CFO and look, I'm diverse. I mean, that's not what it is. It is about giving opportunities to talent across the spectrum. And some may be A players, some may be B, others may be C, and that's okay. I mean, that's fine. That's where we reduce the risk and increase profits or whatever the math there is. So it's a topic that's really top of mind for everyone. And, the best way to explain the scenario in today's market will be how many female founders have actually taken their company's IPO? I would say less than 3% worldwide. And it's a number that's extremely daunting. And not that we don't have female founders sitting at the door waiting to take their company's IPO. The problem starts from the beginning, where they don't receive funding or significant funding enough to make that progression in that journey, right? So it's not that there's tons of deal flow sitting at the door and they're just waiting to get out. No, the problem is right from the beginning. And so I personally do a lot of work. I mentor a lot of female founders. And one thing I hear again and again is the investor didn't take me seriously, or I need to go outside the valley and perhaps try something else. And the problem, by the way, is not inherent in the valley. It's across the globe. So, something to just think about. I don't know if you have a solution for it. The only thing I would say is do your part. If you have an opportunity, help. Help the female founder, help a diverse founder, and I'm sure it'll come back to you in different ways.
Yeah, well said. And obviously that's a lot of our partnership with your team and Microsoft, and a lot of what we're doing here at the Entrepreneurial Center is, again, trying to do our best to provide those resources for underrepresented or minority or female founders, so that you have those opportunities ahead of you, because it is a unique challenge, but relatively ubiquitous. And so everything we can do to solve that, we want to continue to support the ecosystem and the environment. And so thank you for those words, though. So we are coming up on time. I do want to leave a little time here for Q&A, but I do want to ask you both, and Troy, I'll start with you, just on maybe a key takeaway for the audience as they're thinking about someday, hopefully, ringing a bell with us at Nasdaq.
Again, maintain all optionality by being prepared for any one of the options that's there. And by that, prepared, this is how I answer that with more than one specific point, is by being prepared, I mean, have your board ready, have your systems ready, make sure you've got the right partners already lined up, doing, the work with you. There's no, I don't think anything that you can't overcome if you're not prepared for all of the different options. You can go fast if you're prepared. You can transition to a different path, whether it's SPAC or reverse merger, if you're prepared and the market requires it. If M&A approaches and you're prepared, let's not forget, one of the big things at M&A is they're going to want to understand your operations as a company, and having, an S1 type, dossier ready to go at any point in time, you're prepared. Even your corporate deck, as you're presenting to private investors, if you're thinking about yourself as a public company, it becomes more consistent, it becomes more believable. So just always be prepared as if you're going to go public, whether it's 6 months from now or 18 months from now. If you think that might be in your future, I think you should always be prepared to do it.
Well said. Shalom?
So one key takeaway from my perspective is don't take no sitting down. And what I mean by that is, back to Troy's point, market dictates direction. And today, if someone says, well, IPO is not the right avenue, I would say go back to why you started the journey, right? So going IPO or SPAC is not just about profitability, growth. It's just that the story is not there. This real story, the term that Troy used, startup story, is about the problem that you're trying to solve for the market. That's the reason you started the company. So the key takeaway is, please do not just take no sitting down, explore, go back to the basics, go back to where you started, day one of why you started the company. And trust me, the perspective is going to be new. And I do this on a daily basis. It's almost like I tell the customers I work with, I feel like I'm in therapy sessions with them all the time, because it's almost like constantly having conversations that, why did you start and why are you frustrated today? And let's talk about this. And it is a lot to take on. But at the end of the day, feel proud of what you have accomplished and what you have built as a company. Don't let anybody take that away from you.
Yeah, well said. Well, very much words of wisdom from two experts. So thank you both. With that, I am going to I've saved some time here for Q&A. We had some initially submitted questions here. And again, as Anna put in the chat, please feel free to drop them in Q&A, and we'll try to get to them as best we can. There's a few here that we actually answered, but Shalu, I'm going to start with you on this one. It's around ESG, and there seems to be a growing effort we're seeing with companies, both late stage private as well as public, focus on their ESG initiatives and the different frameworks. I guess maybe from an investor side, does this factor into your investment thesis And then from
Yeah.
an advising side, what are you sharing with companies around this?
So the ESG industry in many ways is at the crossroads in terms of the value it really creates. And by value, I mean not just frameworks and metrics and ratings and sustainability claims and fund labels and regulatory scrutiny. What I mean is a mature version of ESG is making its way into the mainstream audience, which is great, which is absolutely phenomenal. Oftentimes in the investment space, any VC or private equity investor will tell you, the moment they put the money on the table, they're instantly thinking about ROI. And in the ESG space, the ROI is often not in terms of dollars, but in the rippling effect that it creates in the economy, society, or community, right? So it has a qualitative ROI rather than a quantitative ROI. And a lot of us have to kind of breathe that in and say, it's okay, the ROI is less, but look what it's doing for the community in terms of bringing clean water using IoT sensors in a community that didn't even have clean water. And so the only reason, I would say, one of the reasons ESG investing is growing is because over time, investors are discovering that the investments in companies with high ESG scores are actually outperforming equal or better to high growth companies with lower ESG scores over time. So simple kind of analogy is, if you're working in the AI space, now I'm seeing a lot of companies do AI for good, right? It's not like a major business unit within their firm. It's just a diversification of business. And that's pretty good. I mean, something is better than nothing, right? And so socially conscious investors want their capital to go into companies that support their values. That is what the key kind of driving factor is. And the investment thesis, back to your question, behind ESG investing is that companies that have high ESG standards are more likely to outperform their peers over time. So that is where the whole thesis comes to. And I would say less reward, yes, but also less risk. You're looking at 6x to 7x returns in some of the investments. Here, you may be looking at 1x or 2x, but it's solving a massive problem in a particular community or even economy. I mean, I can give you many examples of some amazing companies out there. Definitely a great space. And to any founders who are here, I would highly encourage you to think of ESG as a diversification in your business model, even though if it's small, but just give it a shot, give it a try.
Yeah. Okay. Troy, I guess anything to add there on the ESG? I've got another question for you as a separate topic.
No, I touched on that ESG. I think the importance of that as it relates to the diversity of opinions. And, I believe ESG should be more of just the culture of the company than some, explicit guidance that we're all trying to manage to. It really should just be how you think about your company, how you think about the people you're, getting feedback from. That is one of the other reasons I encourage talking to multiple banks. The bulge banks are going to have a different perspective sometimes than the specialty banks that are in your area. So it's about getting diversity of opinion in order to make, because in the end, the management team along with the board is responsible for moving the company forward, but you want to have as much input into that as possible.
Yeah. Okay. So Troy, this one's for you. One of the most important quarters for a company is going to be that first quarter post IPO. So the question is, when did you know, or how do you know a finance team is ready to operate as a public company? Kind of keeping in mind the street models, the KPIs, the financial close.
It goes back to, I think, some of the comments that we made throughout it, and that is you got to be prepared before you even go public. It is about a mindset. Certainly, again, one of the things I talked about is being prepared, obviously, and keep stating it, but do quarterly closes even when you're private. That's really one of the biggest lifts, is doing a quarterly close that first time you're public, keeping in mind that you just had 100 experts help you do your IPO, got all the auditors, the bankers, the lawyers, everybody around the table getting you ready for it. But if you have to then hit the ground running and you haven't done a hard quarter close, it could still create some challenges in what you're able to pull together. So you should start doing things like that ahead of time, making sure that you have line of sight on the team that you're going to need, and when I say team, it doesn't have to be internal. There's plenty of great consultants and advisors out there that you can bring on to help you in that intermediate stage before you maybe hire a controller or before you bring on, senior, certainly people within legal and otherwise, using the network that you can have. Having a board that's, again, a good reflective board will help you connect to those advisors along the way so you can be prepared to do it almost in a virtual manner. But you should treat the last couple of months before you go public as though you already are. Like I said, if your corporate deck is already tight and reflects your story and appreciates the appropriate disclosures, you're not going to be so shocked in the system when you actually do go public.
Well said. A lot, again, back to preparation, have those building blocks ready. Okay, well, I think we've got maybe time for one more question, and this is kind of a bit broader. And Charlotte, I'll start with you, but what has surprised you most about the market this year in 2022?
I think what has surprised me the most is the overconfidence in some of the founders that completely busted. And it brought them down. I guess they didn't see it coming. It comes back to being prepared, right? And there are a lot of use cases that have been public in press. Everyone is reading about it. And there are a lot that nobody is aware of. And so the volatility in the market was, look, the market always goes through ups and downs. I'm not too concerned that the market is not going to pick up. It will. That's the function of the market. We saw that back in 2006. It dipped, it picked up, we flourished, we did really well last few years. It's coming down. It's kind of readjusting at this point, and it'll get better. The point is mentally being prepared that even though you may be IPO or you're getting close to it or you're SPAC, what have you, market is the godfather of everyone. It dictates the direction the company is going. You cannot challenge it. You cannot. Even the enterprise customers. I mean, I'm not just talking about startups. I'm talking about the enterprise customers. A lot of companies are struggling. But the good thing is you just have to ride the wave. Surround yourself with folks who have the maturity, the wisdom, the experience, and patience to help you get through this. And then once the market picks up, you're back in the game. But do not give up. So that has really surprised me, where founders are like, gosh, it's time to close shop. I don't know if I have enough cash. I just tell them, sink or swim. It's your choice. If you want to sink, anyone, you can do it right now. Go close a shop and go back home. Nobody will stop you. There are way too many players in the market. And swimming is where you have enough cash flow. You don't have lofty, ambitious goals. You're like, I'm good. I'm happy with whatever I'm doing. Let me just ride the wave. And then once you come out of it and you do well. So that's where I think I am just taken by surprise. But again, it's a function of the market.
Yeah, great. And Troy, your thoughts on what's been surprising this year?
Yeah, Show's right that the market is the dictator, but that doesn't mean the market is always right or predictable. And I think that's the thing that's thrown me this year is a little bit of the unpredictability of the market, the volatility we've seen around things where today's a perfect example. I think people factored in a 50 basis point change and the market reacted as if it didn't know that was coming, or, I think there was other comments about whether this is the last time. I think the reaction in the market, and then we'll gradually work our way, to a little bit of more stability over the next, but it's been the whipsaw movements that have been a little surprising. And I think this reflects even further kind of what we've talked about, and making sure your company's prepared for different options and different outcomes that you really don't have control over. What you can control is your team, your product, your path forward. You can't manage the other things. Part of being prepared is making sure you've got enough cash you've got different options to consider. We did that large offering back in August, but we had no less than 4 scenarios that we had developed internally, not knowing how the market was going to be when the data came on that Monday morning and got put out there. We were prepared for a couple of different scenarios as far as the overall reaction to the data. Then we were prepared for what would happen in the macro environment. In February, we had just put out our Q, and Russia invaded Ukraine, and I was 15 minutes from going on calls with investors, and we withdrew our guidance around one of the timelines we had. You have to be able to pivot, but be able to then reinforce your story as you're moving forward. And because of that, I think that's where, and Shalu did it really well, is have people around that have the experience. For many, frankly, analysts and investors, this is one of the biggest. 2008 was the last time. So there's people that have been doing nothing but riding a wave since 2010, 11, 12. And this is different to them as opposed to folks that have been around long enough where it's like, yeah, this is another one. So I think having the right people giving you advice and partners is really important.
Yeah, well said, and we'll leave it there. I just, on behalf of NASDAQ and NASDAQ Entrepreneurial Center, I want to thank you both so much for not only your time, but your expertise and sharing your views with us. Hopefully my eyes haven't been jotting off screen too much. I've been writing down a few notes myself. So this is incredible. And for those young entrepreneurs, we talked about the early days in 2009, Airbnb, WhatsApp, Square, and Uber were all founded in 2009, coming on the heels of that financial crisis, right? So it can be done. And I think, Shalu, you gave great words of encouragement, like just kind of get prepared, stay nimble, and hustle, right? Like in the end, that hustle and that merit is going to put you in a great position to have all the options we discussed today. So we wish you all the best. Thank you both for joining us. Great job.
Thank you so much.
Thank you
guys.
Great.
Bye.
Bye-bye.
Colin.
Thank you, Jack, Shalu, and Troy for sharing those incredible insights from your firsthand expertise. For those still on the call and you're interested in booking a meeting with our partners or giving us some feedback on what you'd like to see in the future, please drop your submission into that link that we're dropping into the Q&A box. Before we transition to our last session, Achieving Success as a New Public Company, we're going to take a quick break. Fill up your coffee cups and we'll return very shortly. We'll see you all in a second. right, welcome back to our final panel of the day, Achieving Success as a Public Company. Friendly reminder, we're going to open up for Q&A at the end of this panel, so please submit those questions for us and our panelists at the Q&A function at the bottom of your screen throughout the presentation. We hope that everything shared and provided by our experts so far is timely and valuable as you think about this exit strategy, and we look forward to staying in touch as your growth continues. If you're interested in booking a meeting in our partners, we're going to provide a link in the chat to provide us feedback as well as a place to raise your hand. Now, let's move on to our third panel. So without any further delay, please join me in giving a warm welcome in the chat to our moderator, Katie Hilkenmeyer, who's a partner at KPMG. She was in panel 1 if you were there earlier. We've got Richard Blake, who's a partner at Wilson Sonsini. We've got Priya Huskins, who's a partner and senior VP at Woodruff Sawyer, and Nino Sarkis, a CAO at Amplitude. Welcome, team.
Thank you.
All righty, Katie, over to you. Welcome back.
All right, I appreciate it. Thanks for having me back. Excited to be here moderating. Can't tell whether it's the moderating or the answering all the questions is more fun, but certainly enjoy this program. Little background on myself, and then I will have the panelists introduce themselves. Katie Hilkenmeyer, I am an audit partner at KPMG. I lead our emerging growth practice in the Bay Area, which means I bring on pre-IPO companies, then take them public, and then obviously serve them as a public company for as long as the SEC will let me until they kick me off, which is 5 years. So with that, I will turn it over to Richard for an introduction.
Hi, Richard Blake. I'm a partner at Wilson Sonsini, Goodriff & Rosati, and I chair our company's public company practice. And I've taken many companies public and work with dozens of public companies now on all of the things that they have to do as a public company: SEC reporting, corporate governance, working with Nasdaq and the NYSE, Delaware law issues, activism, etc. So happy to be here, and it's a pleasure to be on this panel with some good friends, actually. So,
all right, Priya.
Hello, everybody. Priya Huskins here, one of the partners at Woodruff Sawyer. We're a full-service commercial insurance brokerage headquartered in sunny San Francisco, servicing clients worldwide. We do all lines of commercial insurance, including employee benefits. I'm an expert in director and officer liability insurance. I serve on 3 public boards myself. I also chair Woodruff Sawyer's D&O claims group, so I've got all the good stories. And I will mention here that Woodruff Sawyer is the market leader when it comes to D&O insurance for new public companies.
All right, thank you. And Nino.
Hi, everyone. Nino Sarkis, Chief Accounting Officer at Amplitude at the moment. Prior to that, I spent my whole career at PwC, where I was there for 20 years. Katie, don't hold it against me. Worked on a multitude of tech companies, software as a service. I also did a lot of what Katie currently does in the pre-IPO space, and took a number of companies public. I made the switch into an operating role around 2 years ago. And so now, again, I'm the Chief Accounting Officer at Amplitude, also head workplace, and been doing that for 2 years, and took the company through a direct listing just over a year ago. So pleased to be here. Nice to meet everyone.
All right, excellent. Thank you. All right. So this panel, just success as a public company. Richard, I'll direct this one to you first, but being a public company does call for significantly increased transparency from internal and external parties. How do you think a newly public company can set itself up for success prior to the IPO, as well as in the first, couple years as being a public company?
It's a great question. It's interesting because if I explain what I do to some people, they say, well, what makes a company a public company? Why public versus what other kinds of companies are there? And I'm like, well, in my world, there's public and there's private. And they say, well, what's the difference? And the actual answer, I think, is that the company's stock is publicly traded now for the first time on a stock exchange like the Nasdaq or the NYSE. But what goes along with that is that now pretty much all this financial information that the company used to be able to keep private, at least for the most part, is now public. and all sorts of things, all sorts of activities that happen at the company are now filed with the SEC or issued in a press release so that the public can see. So how do we prepare for that? I think as I see it, and would love others' thoughts on this as well, but I think one of the biggest transitions from being a privately held corporation to being a public company has to do with the quarterly earnings cycle, right? And that's in two ways. Number one, the whole process of preparing earnings, speaking to earnings, getting on a conference call every quarter with investors and explaining what's going on and answering their questions about the business. And that's something that many public company, newly public company CEOs and CFOs who haven't done it before are doing for the first time. And so one thing that I saw with one of the companies that actually Priya and I, it's both a client of both of ours, is they sat down, and they've been public now for a good long time, but their CEO and CFO sat down with their board every quarter and had a mock earnings call. And the CEO and CFO prepared a script. They gave opening remarks. They had, essentially an earnings release that they gave to the board in advance, and they had some pretty good board members who had experience in this, and they got questions, and they had to sit and explain themselves to their board. Just that process of, having to explain quarterly results well in advance of when they were actually sitting on a conference call or even meeting with investors in a roadshow, because that's sort of the first salvo into this. And then the second thing I would say, that how companies can set them up for success. Again, many private companies are not reporting their numbers or doing their books, at least to the level of accounting standards that Katie expects to do once they're public, on a quarterly basis. They do an annual audit, but if they prepare quarterly financials, they're sort of short form financials. They're not done to what I still think of as SAS 100 review. I know there's an ASC out there that I don't know exactly the number of, Katie. I still call it SAS 100 review. But most companies are not doing that on a quarterly basis. So I think that actually is also a change. And so getting people, and I'm not saying that they have to start doing that on a quarterly basis in advance, but they have to start setting up, even as a private company, the systems and the protocols and the controls, so that eventually they'll be able to do that on a faster time frame. The last thing that I'll mention, and you've probably heard this from a lot of people already, is that the current SEC that we have is on a regulatory tear right now, and they are proposing a lot of rules that will result in additional disclosure from companies. And in some cases, companies will have, who are emerging growth companies, newly public companies, might have exceptions and not have to give a lot of disclosure up front. But in other cases, once these rules do become effective, and many of them we're going to start to see become effective next year, there's going to be a lot more disclosure. Things about climate change, rules about cyber security, rules that were adopted today about the company's insider trading policy and 10b5-1 practices that are going to have to start being disclosed. And so, even when Ninos went public with his company a year ago, things that he's having to deal with in the first year of his being a public company, in the next couple of years as companies go public, there's going to be even more disclosure. And so just being prepared to talk about a whole bunch of stuff that you're not necessarily thinking of, you're going to have to disclose is something that's important to keep in mind, because the SEC is just moving more towards more disclosure on a lot of different topics.
Excellent, thank you. And certainly as your auditor, we are following all those additional disclosures that we all get to focus on. Priya, from your perspective, how should a company focus or views change pre-IPO and then also as a public company?
Sure. Well, thank you for that great question. The focus for any company thinking about going public and then immediately after they go public is obviously execution, right? They have a plan. They told investors what they plan to do. They need to execute. And what that also means is that as they're making their plans, they need to upgrade when it comes to enterprise risk management. Now, what I often find when I'm talking to a pre-IPO company is that their enterprise risk management, including the insurance part, is like some sort of hodgepodge and unholy mushroom growth that has popped up here and there. And that's awful. Instead, what a company hopes is that they're going to be ready for public company scrutiny. Because remember that enterprise risk management effort, including the part that you transfer to insurance carriers, it's all about having a safety net when you're out there in the public eye. So part of readiness is absolutely working with your trusted advisors, the Richard Blakes of the world, but also, I hope, insurance professionals to help set up very often a brand new chassis so that you are ready for scalability and growth while you're in the public eye. And you don't want to be doing that after you go public. This is an exercise that needs to be undertaken a year to 18 months in advance. It's part of your readiness. And I will give you an example of technology, errors and omissions, cyber insurance. It happens all the time that I'm talking to a company that has 75, 100, 150 million in revenue, and they're paying like a thimbleful for their technology E&O cyber risk policy. And what I know is that means their carrier has absolutely no idea what they're doing, right? So they're very happy because it's very cheap, but it's not an authentic policy in that nothing's actually being insured and it's not sustainable. The last thing you want to have happen is to find out that some of your fundamental business costs are skyrocketing after you're public, after you've given your board your budget and all of that. So again, this is part of the readiness, is you may be shedding the water wings and getting ready to swim in the Olympic-sized pool, right, with a big boy bathing suits. That's part of the process. And so again, the point here is starting early, working with people who really understand the insurance market. A lot of people on our call today are in innovative, very interesting companies with non-obvious risks. So working with somebody who can do that timely so that by the time you go public, most of your insurance risk management is stable and you have good visibility on the cost. I recognize that for new public companies, D&O insurance is often the show, particularly for directors. It's literally in the name, right? Directors and officers liability insurance. And that's important. It's necessary, but it's not sufficient when you're thinking about being a new public company.
All right. Thank you. Ninos, you have been a CAO now for 2 years, a year prior to the IPO, and then a year post-IPO. Love to hear some of the learnings that have transpired over the last 2 years, from when you were talking with investors, maybe before the IPO, to what you're learning now, and even as well as things maybe you wish you had known prior to actually flipping public.
Thanks, Katie. Yeah, it's certainly been a fun ride for the last 2 years, to say the least. So, I'll take a couple of pieces of that. So specific to investors and getting ready for the public markets and your quarterly earnings and helping analysts, both buy side and sell side, really understand your business, I would say start early. One of the things, which we figured out in the end, but as you go through a confidential filing process, you've got a number of blackout periods where you can't talk to investors. So you really need to start your NDR, your non-disclosure roadshow meetings early prior to that period. So think about the list of who you want to get to, and there's a well-known list of which investors you want on board and which ones you don't. And start getting ahead of those people. And then I would say it takes a number of meetings to really educate, some of these guys on what you do, especially as a B2B enterprise software business. When you're more B2C and it's more well-known in the marketplace, it's relatively easy to understand. When you're explaining, what we do, something like a digital analytics platform where we're a category innovator on digital product analytics and really helping people, including investors and other stakeholders, understand the value of what we do, how you understand real user behavior specific to what's going on in a digital product. It takes a little bit of education prior to that. So I would definitely counsel people to start that early, including what your product does. Richard brought up some great points around preparation. We did a number of mock earning presentations. We did have, whole scripts written out, even an earnings release written out. We had FAQs, we had board members joining and doing all of that practice. I would definitely, coach people to do that as well prior to going public. You probably need at least 2 quarters worth of reps of doing that without a live experience after you go public. On the concept of transparency, I also think that's key. That's one of the things of really understanding and making sure everyone at the company agrees on what key metrics are going to go into your initial S1, which ones you really want to drive investors, stakeholders, analysts to really understand, which ones should they be focusing on as forward-looking indicators of revenue. Should we be looking at, for example, RPO, which is your remaining performance obligations versus calculated billings, really helping them understand that process. And you can do it through meetings to a certain extent, but making sure everything's fully disclosed in your S1. And then even post-public, as a newly public company, it's really interesting to see that at the beginning of earnings calls, you have to kind of reiterate, hey, this is what we do as a company, this is the category, these are the key metrics you kind of need to focus on. And then, that comes out in the form of callbacks, etc. Maybe just quickly from an operational standpoint, obviously having led the whole public listing project, and we actually went through a direct listing as opposed to a traditional IPO. So there's a bit more heavy lifting on us, especially on investor relations and that kind of stuff, but also just internal to the company, real company education as to what it means to be a public company. We talked about quarterly earnings and financials and 10Qs and 10Ks, and some of that stuff's, inbuilt to the DNA of finance teams. But if you go outside of the organization, whether it's sales, revenue operations, deal desk, product teams, and, God bless our teams, they're all fantastic, but it takes a lot of education to help them understand exactly what it means to be a public company, accuracy of bookings and revenue on a quarterly basis where people are expecting certain numbers, and really getting the whole machine to work together, especially post-public. I can't overemphasize how important it is to do that aspect, and just make sure you're partnering with them. So one of our key things in finance and accounting is business partnering, and how can we help the go-to-market teams partner well? How can we help the product and engineering teams partner well? What kind of bets or investments are they making, and how do we evaluate ROI on those? And business partnering gets a lot more emphasis and scrutiny as a public company when you're evaluating each of your bets even more closely than you were historically as a private company. That's a good summary. I think that those are the main ones I would call out.
Yeah, and I think that is a perfect segue, Ninos, into that partnering. What we have spent quite a bit of today in the morning, as well as talking about now, is those trusted relationships, whether it is with a service provider or now with partnering with the different business operations. We have certainly seen a war for talent over the past couple of years. We, 17, 18, 19 with the IPO booms, and then it did not stop during the pandemic. Significant, the Great Resignation, significant hiring, people moving around. And so I would be very curious, Ninos, to double down on that a little bit with you on how are you seeing the war for talent right now? What is it looking like? And especially as the IPO markets are likely going to be closed, but also as a newly public company, how are you viewing the current resumes and what are you seeing?
Yeah, that's a super hot topic, very relevant, Katie, in the current market. And I'd say it almost changes by the month based on what we're seeing. It's pretty insane, just with what's going on with the macro. If I go back to, just before we went public, let's say all of 2021, even just after going public, it really was a war on talent. It's really hard to find a strong pool of candidates for any of the positions you're interviewing for. The depth of knowledge and relevant experience was hard. As soon as you find candidates and you pick one, there's probably multiple offers that they have, and you're having to go above and beyond your typical compensation ranges to land those people, and that was happening. That was happening pretty consistently going back into last year. I would say the beginning of this year, it started to cool off a little bit, obviously consistent with what's going on in SaaS and the macroeconomic conditions. I would say in the last 4 months, it's turned a lot. I mean, the positions we're interviewing for, especially in finance and accounting, there seems to be a lot more higher quality candidates available. There's less ridiculous multiple offer situations that we're dealing with. And you're really able to take the time and at least try and stick to compensation ranges. The other thing and I'm sure a number of other SaaS companies and technology companies in general have had to deal with is, the split between salary and equity and compensation ranges. And, when valuations aren't as high as they were, we have to keep a really close eye on stuff like dilution and how much equity are we able to issue for each of those. And I'm sure a number of companies like us are dealing with the same sort of situation. So again, it also contributes to having to keep an eye on talent. I would say retention is always an issue post-public, because you have a number of people who are fully vested and been at the company for a period of time. And I would say it's really important to keep an eye on people morale within the team and what stuff you could be doing to keeping those people happy, because you get your typical, well, I've been here for 4 years, I've done my best, let me go do it again. I just prefer a private company environment. But then you also got, the additional regulatory risk management aspect of being a public company. And some people, quite honestly, might not be cut out for it or just don't want to deal with it as a public company. So doing your best to keep an eye on the key team members, the ones that you really want to keep around, and help reduce attrition risk by doing whatever you can as a company, whether it's incremental benefits, events, what you're doing in a hybrid versus remote format. We currently are in a pure hybrid format, so we ask people to come in for the most part once or twice a week. It's been an interesting change from full remote, where some people really gravitate towards it and some people might not necessarily like it. So my counsel there is, kind of pick which one you want to be as a company and go with it, and try not to make too many exclusions here or there, because then it gets noticed across the company. But yeah, I think we're all mucking through the same sort of thing, but it's definitely changing on a month-to-month basis as everything continues to evolve here with the macro and also the return to office that most companies seem to be doing.
Excellent. Thank you, Ninos. And certainly, Richard, that war for talent, that need for talent extends to the boardroom and potentially needing to refresh the board as a public company. Can you talk us through what that might look like?
Yeah, and I love Priya's thoughts on this too, since she's in the thick of it as a public company director herself. But I tell companies that are in the pre-IPO process that they're about to start a cycle of board recruitment that basically never ends. In my view, I've got companies who've been, that I represent that have been public for 40 years, and they are often there's usually one director a year maybe, or one director every 18 months that they end up having to replace for a number of reasons. And so it is a almost constant process of board recruitment. And what we find, obviously, in the world that I live in the tech world and in the biotech world, you have a lot of pre-IPO directors who are investors. They've been venture capitalists or insiders at the company. And so they have a board seat. They tend to like to have that board seat for a little while after public. Some of them get off right away and they're like, we don't want to be directors of a public company. Others say, we'll stay on for a little bit, but as we sort of sell out our position, then we're going to go, we want to go off and spend time with the other venture-backed companies that we have and get them ready to go public. And at the same time, you also have a number of expertise issues on the board that you need to have. So you end up needing to have, a financial expert. You need to have people who have broader sort of skill sets. It's helpful for your CEO to have maybe another public company CEO on the board that they can talk to. As well, as most people are aware, there is a huge push for having diverse candidates on boards. And in fact, there's a number of regulations that require either you to have diverse people on your board or to disclose whether you do or not. And if you don't, in a variety of categories, why you don't. And that those regulations and the investor push to have those sort of diverse candidates on your board is not going to change anytime soon, even if various regulations like the California diversity laws have initially been struck down pending appeal. The investor sentiment behind it is not going anywhere. So there is a constant need to refresh and to refresh with people who have broader expertise than the VC directors, who great expertise, but they want, the company's going to want to have directors with even broader expertise, broader skill set, as well as diversity. So those are all things that companies need to be familiar with and aware of, both in the IPO process, but also just on a constant going forward basis as they are a public company for years to come.
Excellent point. And you set that up. Priya, take it away.
Yeah, you bet. But actually, before I hit boards, I wanted to mention something that came to me as Ninos was talking. This whole thing about sector and skill specificity for what's going on with recruiting and retention is insane. It is so volatile right now. So if you have a fabulous, I think we don't call them HR anymore, human people person, just hug that person in a professional way, because it is so hard to recruit right now. My favorite new phrase is employee hoarding, which I think it's pretty obvious what that means, right? Companies that spent all this time and effort to recruit their people may be hoarding them in the absence of enough work, hoping that the dire winter that was predicted is not so dire. So I just wanted to share that, employee hoarding. Turning to boards. So, first and foremost, if you are looking at going public and getting through that window effectively, and I think Richard hit this so well, you've got to get the right people on board in a timely way. And I want to be really specific about the audit committee chair. The good audit committee chairs, they probably were CFOs who took a company public. They've done it before. They are cornerstone independent board members. And those guys and gals can't, they're pick of the litter. And so if you want one of those people to be on your board, and make no mistake, it's often a early indicator of how successful you're going to be, you need to start wooing that person early. The very good audit committee chairs will not be joining your board 4 minutes before you go public, not at all. And so how do you get them? Early conversations, effective networking. There are recruiters, but for this kind of activity, it's probably more introductions, warm, Richard, Ninos, they all know people, as do I. And it's a question of availability for those very good directors. Those good directors are looking for things in addition to, are they interested in the business? And do you all seem like competent humans? They are looking for things like a commitment to corporate governance, a commitment to doing things the right way. Corporate governance doesn't matter until it's the only thing that matters. I think we can all think of a 3-letter company that's proving that for us one more time, because we will keep learning it. So corporate governance commitment, and frankly, and I am talking my book here, D&O insurance. Those are 2 fundamental things that you can do as a company as you're reaching out to these very good board members in order to help them come help you. And why would they put their personal wealth and their personal reputation, maybe more importantly, at risk for your company without you making the real commitment around these important issues?
Priya,
please.
Oh, I'm sorry. I want to put a really fine point on it, because I think the best situations where you bring on that audit committee financial expert allow for that audit committee financial expert to go through an audit with the company
Yes.
before the IPO process even starts.
Mm-hmm.
And so if you think about that being your goal, and almost like you said, like some audit committee chairs are going to demand that, as opposed to like, they just won't settle for anything else. That backing up from that, you realize that you're recruiting that person like several years before your IPO, or at least you're in the process of doing that. So I just wanted to interrupt with that very fine point, because I think what you're saying is really important.
Yeah, and I completely agree. And maybe it's not that the person is on your board, but is an advisor informally to the CFO or the CEO or the rest of the board. But there's some relationship there, so that it's a warm entry and not a cold start. So that's the first thing. As Richard said very well, there are increasing numbers of regulations. The SEC seems to be pushing us towards having a director per skill, which is absurd. Please don't do that. But it does mean that as part of the process, we see more and more companies being very effective about setting up a skills matrix and figuring out who's who in the zoo. If we're going to have to talk about cyber or climate or whatever it is, do we have more than one person who could actually fill that role? So that skills matrix process points to something else that I think is less obvious. And a good nominating and governance chair is also very important. So Richard alluded to the professional investors who kind of know the score. They're not holding on. I'll tell you, the worst situation is the founder CEOs got the college roommate on, who's groovy, God bless me, groovy guy, but bringing nothing to the table, and nobody wants to say it, and it's kind of awkward, and that guy sort of knows and is talking a lot in the boardroom for no good reason other than to just take up oxygen to seem important. It's a disaster. That's where a good nominating and governance chair is worth his or her weight in gold. Don't make this the CEO's problem. Run a process. It may be multi-year, but run a process. And as a private company, very good practice for what you're going to be doing as a public company. But make no mistake, that super fancy audit committee chair, like that person's looking to see who else is going to be surrounding this person, and doesn't want to be kind of the one non-clown board member. So to think about that and plan for that ahead of time is very important.
Excellent. What I think a common theme, I said this earlier, is that planning well in advance, and then it does not end once you are a public company. It continues from the regulations to the hiring, all throughout the entire process.
Katie, if I could just add one quick point.
Yeah, please.
So the very good board members will be doing their diligence. And I think sometimes companies forget your advisors are there to help. So it's completely appropriate to bring your advisors in to have a discussion. I know Richard Blake, I'm sure, has conversations with prospective board members around D&O insurance and enterprise insurance risk management. That's something that I do very regularly. And that demonstrates, right, to the new board member, we're planful, we've got the right ecosystem around you to support you. Yours is not the IPO that's going to lead to humiliation and embarrassment. This is going to be at least a right down the middle, fine one, if not a really good one.
The only other point I was going to make, Katie, and sorry for interrupting too, again, is and to tell this, I want to tell a story about my own personal life. So my wife and I had a son, then we had twins, and then we decided to have a fourth child. And I thought, okay, after twins, come on, like this is going to be easy. One more child, like one feeding, one changing, like that's nothing. And what I forgot was that I still had 3 other children. And so one day I was talking to my father about it, who's a mathematician and an engineer. And I was telling him like, oh my gosh, like I didn't realize how hard it was going to be. And he said, you made a really fundamental mathematical mistake, son. And I said, what do you mean? And I said, well, you thought that human interactions get more complex on a linear basis when they actually get more complex on an exponential basis. So adding one more person to it, like that one person has not just a relationship with you, but a relationship with all the other 4 people in the house. So point being, how does this relate to director recruitment? If you start to throw a whole bunch of new people into a board environment at the same time, that can create potentially can create chaos. And so the ideal thing is, and again, like we've talked about all these different sort of skill sets that you may need to have, or characteristics in board members. It may be useful to bring them on sort of one at a time and let that gel, and then bring on another one at a time and let that gel. Because if you bring them all on at the same time, it's about to totally redo the whole dynamic of the board. So just a thought.
Excellent. No, good point. And I think it's probably something similar, Ninos, when you are running a company. How does that look from when you are trying to partner with the business as well as your accounting department, finance, if you're trying to bring on a whole host of new folks versus a thoughtful approach?
Yeah, I couldn't agree more on the planning. I mean, just to put a nail on the board appointments, I mean, we were working through audits and getting audits caught up well before we went public, and we started doing audit committee meetings at least a year before we went public. So it just gives people, you know, and during my time at PwC, I saw multiple companies take that approach, if not even earlier. So I couldn't agree more with the panel on that stuff. And yeah, the same holds true with the rest of the organization, especially when you're high growth and you're adding, you know, significant percentages to your overall headcount year on year, and you're putting them into different teams across the org. I would say it's very important to keep culture intact, like have a company culture, have values, and make sure as you're going through interviews and hiring and all that you're hiring people that would be consistent with those. And then onboarding and assimilation, making people feel welcome, helping them get up to speed as quickly as possible. You know, staggering it out. Don't try and hire, you know, 4 accountants into the revenue accounting team in one quarter, because that's just a recipe for disaster, and kind of split it across the different functions and teams. And then it's amazing to me how, you know, the simple things like documentation of policies gets lost as you're, you know, just growing and trying to deal with all the operational challenges. But if you have, for example, a documented bookings policy, every time you hire an order management person, you know, hopefully you're doing enough training. But if you're not, they have a policy doc to go fall back on. And if you're not getting into the cadence of having good documentation across the company, again, whether it's finance, accounting, RevOps, deal desk, wherever it is, you know, it's just it's not going to be conducive to them getting on board and productive as quickly as possible. So I would say, you know, make it easy for them to do to kind of grow and assimilate by having the, you know, the good hygiene in place, again, well before you go in public and as you're hiring all these people.
Excellent, thank you. One of the earlier panelists said the IPO is equivalent to the engagement party. After that, you have all the planning, you have the wedding, and then you have the marriage. So that IPO is really just the beginning of a long, hopeful process here. And so with respect to that, it really is a journey. Richard, maybe you can tell us, as a corporate securities officer involved before and after, some thoughts on what to do and what not to do before and after, and certainly, you know, some of those key points as a public company, some items to watch out for.
Yeah, so a couple things, and one of it comes back on what we talked about a little bit earlier about like the being newly public and like the earnings cycle and all of that. I mean, I think one of the biggest challenges that some companies can face is learning to forecast. And you know, one of the call that Priya does not like to get in the first year of a company going public is, we missed our earnings, because that almost always leads to litigation that Priya ends up, you know, having to get involved with.
It's not ideal. It's not ideal. It's not what you're hoping for.
It's certainly like it can happen and you can live through it, but it's not ideal. And so, and a lot of that just kind of, and it's hard. It can be really hard to go from, because the companies are going public, like the whole reason they're going public is because they're scaling. They're scaling really fast. They're scaling with employees and costs. They're scaling in jurisdictions, locations, international sales. They're scaling with their revenue and growing at a pace that allows them to then take advantage of the public markets and want to sell their stock to public investors and have that liquidity for their employees. But if they can't forecast, and so I think one of the hires, as we've talked about early on, I think is trying to get good people who can, in the finance team, who can help do the forecasting and help work with, not just the reporting of it all, which is important, but also the forecasting of it to get ready. That gets into my next topic, which is like, I think one of the biggest challenges that I sometimes have with a company is once they go public is, man, like, we used to tell our employees everything. We used to sit down in town halls and go through the nitty gritty, and everybody knew everything. And you're telling me now that if I can't tell, like telling everybody everything, like might mean that they're in a blackout and they can't sell their stock. And so like some of these conversations, like how do we go from environments where we may have been completely transparent to how do we keep that culture of helping employees feel like they are aware of things and they know what's going on at the company in the same way that they did when the company was private, but also do it in a way that allows them to also sell their stock at a time when they want to and not be completely locked up from stock trading. I don't have, and by the way, that is a company by company discussion and analysis. And I don't have the silver bullet that I can share with everybody to make the problem go away. It's a conversation I think that's had company by company, but it is a discussion, and it sometimes is an evolution, and sometimes the evolution starts before they're public, and sometimes it's an abrupt sort of trying to help deal with things as they're public. The related aspect of it is the stock trading and being, helping employees be aware, like, what does the IPO mean for you? What does it mean for your equity? What is it, what is the lockup period post IPO, if there is one? Ninos, I don't know if your direct listing had a lockup or whether employees were all able to sell. That is an advantage for some direct listings, but there are some direct listings that do have lockups. But sort of curious what your experience was that way.
Yeah, no, we were able to, we allowed employees to sell immediately. It was a closed window because we went out right before Q3 and then we went into a closed period, but there was 2 or 3 days of available trading. So that's definitely one of the advantages of the direct listing. But yeah, I can agree more on the employee information aspect. We went through that firsthand, and we're a founder-led company. Our founders are still at the company and still driving it strong to this day. And it's very important to them to keep people informed and happy. And we had to make a number of changes around what we can and cannot share, especially going into closed periods and quarter end and whatnot. And it's all about change management and helping them understand why, from a risk management standpoint, we just can't do it. And it's actually in their best interest that they don't know, in case, God forbid, there's some sort of unusual trading activity that happens and they know a piece of information that they shouldn't. But yeah, we had to deal with exactly the same issue. So I'm sure a lot of companies have to go through that.
And sometimes it's a matter of even access. Like some people, like, who has control access over certain information, who can go into systems and find out what the revenue or the billings are, or the expenses at any one point or time. But I think
I do have to say, this is where a well executed, timely kind of compliance training makes a big difference. My favorite example is individuals being very upset that they're not being regarded as Section 16 officers right until they find out what it means to be a Section 16 officer, which is, of course, highly restricted trading. And explaining that can make sense. But boy, Ninos, you said it right, particularly founder-led companies where there's a real commitment to transparency. It can feel hypocritical and antithetical to the ethos of the company to say we're locking information down. And so, getting your advisors in early, I know Richard does this training, I do this training for our clients, getting them in early to explain the why and to explain why some of the information lockdown is actually about caring for our employees makes a big difference. The worst possible outcome is, they've been at public companies before, they'll figure it out. No, they won't. No, they won't. They'll figure it out by leaving.
Yeah, no, on that, yeah. And on that point, Priya, what else from a risk management standpoint, what are some traps or things people need to be conscious of?
So from an insurance risk management perspective, I actually think it is worth spending a minute on what's going on in the D&O insurance market. And I have to tell you, this part of 2022 has been so much better than 19, 20, and 21, where by the middle of 21, I was just dead inside because people were out of breath, gasping at the cost of D&O insurance for a new public company. At the height last year, the cost for the first $5 million of D&O insurance was more than $1 million with a $10 million deductible. So just to be really clear, that means if you got sued after your IPO, you would absorb the first $10 million of loss, defense costs or whatever. And then you would have paid carriers $1 million for the first $5 million. If you're a $1 billion market cap company, you're not buying $5 million of insurance, you're buying a lot more. So almost catastrophically expensive. And people who went public in, let's call it 2019, and couldn't freaking believe how expensive that was, freaking believe being a technical term in insurance, got to experience the joy of the 2020 renewal, which was even higher. Things have radically changed in the market. I gave you $1 million for the first $5 million of insurance at the height of the hard market. Today, an IPO company of about $1 billion in market cap is looking at, let's call it $400,000 to $500,000 for that same first $5 million of insurance. And it's even a better price than what you're imagining because the deductible self-insured retention is no longer $10 million. It might be $2.5 million. For the record, that's actually still high compared to mature public companies historically, but it's so much better. I don't have to dodge rocks in the boardroom, which, for my health is so much better. And the reality is people weren't going public so that they could invest in the plaintiff's bar and the modality of buying D&O insurance, right? Like that's ridiculous. So it's great to see this pricing moderate a little bit. You still have to prepare for it. It's still much more than what you were paying as a private company. And so that does get to the traps for the unwary. Not getting an accurate price soon enough is definitely one of them. Another one that is shockingly common is believing that the same insurance broker professional who did a great job for you as a small private company is somehow going to be the right insurance broker to take you to this next most difficult level and as a public company. That's kind of like imagining your brother-in-law who does trust in estates and totally did a great job incorporating you is going to do your S1. It's two very different skill sets. And what ends up happening though is the law firm thing is more obvious. Sometimes small insurance houses wholesale, so they put somebody in the background, clients pay more, it's not as good. So one trap for the unwary is just not asking the question, hey, who's doing the D&O insurance? Is it people who actually do this a lot? Just like you would ask for your accounting firm and your law firm. Insurance is not a commodity, it's highly negotiated. So that's one. And the second one is just not paying enough attention to the process. A little bit of attention, feathering in the process and the rest of what Richard and his colleagues are doing makes a big difference. That is to be contrasted with not really paying attention, not asking your CFO to really engage or your chief legal officer, foregoing sometimes the opportunity to have a very charismatic CEO explain the company overview. There are these things that you can do that will set you up for better D&O insurance right at the beginning and then over time.
Priya, can I ask a question? Is the D&O market, and I actually don't know the answer, but I hope this is a softball question. Is the D&O market for companies who've gone public through the direct listing process or through the traditional IPO process, is that about the same as it is for SPAC companies right now?
It's a great question.
Gone public through the SPAC process, because there are different risks.
Correct.
Profiles there. And so I'm just sort of curious what the comparison there is right now.
I will tell you, overlaying the entire thing is the macro environment. There's a sense in which D&O insurance, like most insurance, it's a closed system. So right now, there's a lot of capacity that came into the market, and that is in some sense overwhelming everything else. Supply and demand, we suddenly have a lot of supply, a lot less demand. Looking at you, Fed, please fix that. We would all like to see more capital markets transactions. What we did see though, and when markets are harder, you actually can see the differentiation more clearly. No question that SPAC companies going public through the modality of a de-SPAC transaction or being charged more did have higher self-insured retentions. We do see pretty much parity for well-run direct listing versus an IPO, recognizing the Supreme Court is now reviewing what we actually think the 33-Act risk is for direct listings. Fingers crossed on that, right? We're all like that, oh, come on, be business friendly for once, we'll see. But at this time, carriers they feel like if you've got a good outside counsel, you know what you're doing, you're evidencing that you understand the steps, you're not going to see very much difference between an IPO and a direct listing.
Good question. I was curious on that one too. Thank you for asking it.
Thank you.
Yeah. Ninos, from a risk management standpoint, what were you really focused on the first year as a public company?
A lot of your usual suspects in my role. So financial statement accuracy is always key for me, obviously, right? Especially as the chief accounting officer and Section 16 signing officer. But, you definitely don't want a mishap like that in your first year of being a public company. SOX is a usual suspect, and everyone groans on the Zoom as I say the word, as I say SOX, but it's very important. You implement it, but you implement it with a mindset of it's good for the company, helps with risk management, but you also do it in an efficient manner, meaning you don't just throw in controls for the sake of controls. You do something that, actually adds value to the business and you can keep it scalable. I think that's that. A few of the other ones, I know you asked about traps earlier, Katie, and, just touching upon some of those with a lens of risk management is, I think Richard mentioned it, like forecasting is key. You don't want to go out, especially as a newly public company, and put out guidance that you then have to re-guide to. So really having your ducks in a row on forecasting accuracy, what you think you're bulletproof going to hit by way of revenue and costs and operating margin and free cash flow. And then working backwards from there as to what you set guidance to the street and how likely you think you are going to hit it. And that's absolutely critical, especially as a first year public company. Kind of related to that, don't underestimate the costs of being a public company. We talked a lot about D&O insurance, which I think by this point is on most people's radar, becoming a public company, maybe not the amount. And so, get up to Priya's point, get up to speed on that before you go public, and don't make it a surprise in your board plan immediately go after going public. But there's lots of other stuff, whether it's additional headcount to keep up with more reconciliations and more controls, or, it's more expensive to, have an auditor audit a public company. You need internal consultants to help you with your control stuff, but there's just, a number of things that you should be mapping out in the 12 months before, so that you're not changing board plans for stuff that really you should have known ahead of time, right? So due diligence on cost of being a public company. Cost efficiency is becoming more and more of a hot topic with the current macroeconomic conditions. You're seeing, more of a focus on the rule of 40, especially from the analyst community and how they value companies. It's not growth at all costs. It's managed growth. It's efficient growth. It's looking at free cash flow. And so it becomes really important, especially on finance teams, to look at cost efficiencies, whether it's through looking at vendor contracts or your software agreements, how efficient you are on headcount, what your ROI is on certain investments, what you're doing with your asset management. Like, if you have a bunch of excess cash, you can actually get decent returns on it by way of fixed income. So that obviously helps free cash flow. I'd say that's something certainly to look at. And probably a last one is a little bit of a sleeper, but your stock and equity plans, have a look at those before you go public. Make sure they're aligned with what the requirements are for being a public company. Look at it on a country by country basis, because they all have slightly different rules. If you're moving from options to RSUs, that's an even more complex problem to solve. Can your E-Trade or ShareWorks or whatever equity platform you're on facilitate trading on day one, which is what we had to deal with as a direct listing? And that's obviously absolutely key if you don't have a lockup period. And then Yeah, the normal stuff on disclosures and what you can and cannot say. And I think we touched upon this earlier in earnings releases, callbacks, scripts. It all has to be consistent, all has to be matched, and you can't just be throwing out new metrics that people haven't heard of for the first time. So risk management, keep an eye on disclosures and what you're saying in earnings and callbacks.
Excellent. Thank you. Music to my ears as the auditor. Appreciate that. All right. Before we transition to the Q&A, maybe some final takeaways for the audience. Richard, let's start with you.
This has been great. I've really appreciated being able to be on the panel with Priya, Ninos, and you, Katie. The one thing that I will say again is that I'll just follow up on what Ninos just said, because I literally just this week got a comment letter from the SEC where the SEC, once you are public, you don't get reviewed a lot right up front, but they do in the first couple of years review public companies, not at the same level as you will through your IPO. But I was reminded once again that the SEC will listen to your conference calls. And so what Ninos just said about being consistent on your earnings call, in your earnings press release, and your earnings script, and in the 10K or the 10Q that you file, that's super important, because this company that I just got a comment letter on, they were saying, well, you talked a lot about this metric in your earnings call, but you don't talk about that at all in your press release or in your 10Q or 10K. Like, why is that? And there's actually a decent answer for why that is the case, but just know that they also, not just the investors are listening, but the SEC is also listening, and it's important to keep the disclosure consistent. You'll hear that in your IPO as well. Like, the S1 needs to be consistent with your roadshow, needs to be consistent with the discussions that you have with investors. That just continues on as you are a public company, and the need to be consistent in your public disclosures.
Excellent. All right, Priya, a takeaway.
So my big takeaway for folks is to advise that you figure out what you must do versus where it makes sense to rely on pros. So you and only you can run your business, set the strategy, execute against it. But the Richards at the WSJRs, the Katies, right, at the KPMGs have a ton of wisdom and expertise when it comes to IPOs, direct listings, and also being a public company. Katie, I was laughing at the analogy you used, because the one I always use for going public is the wedding is a party. The trick is staying married happily. And if you want to have that second good part, right, and not just, that gruesome, we're going to grind it out till we die kind of marriage or public company life, but rather like some joy and happiness. And it does make sense early to figure out who are your trusted advisors and rely on them. And that wisdom, that level of expertise and experience will actually save you so much when it comes to time and efficiency and money over the long haul. So that's my advice.
All right. I like it. Ninos.
Just a few quick takes. I think we heard preparation a number of times, doing stuff early. Organization and project management is key, especially as you're going to be a public company and then post-public. When you have great consultants and help and people who can advise you, like Katie, Richard, and Priya, lean on them. Absolutely. I mean, it's not the first time anyone's gone through a public listing process or been a public company, so lean on them. Lean on your network, your equivalents of other people in operating roles who have done it. Make sure you ask for help. And then the last thing I'd say, and we touched upon this a couple of times, your team is key. I am nothing without my team. And if you don't have a happy team that's driven and motivated and has strong morale, you're not going to get very far. So I would say focus on people, especially in today's environment.
Okay, excellent. We have a couple minutes for questions. I think I'm going to have one for each panel member. First one, Priya, for you. You spoke about the cost of D&O insurance, and it is coming down right now in the macroeconomics. Is that typical? Like, without the macroeconomic, I guess, what does the life cycle of D&O insurance look like?
Absolutely. So remember that there is a 3-year statute of limitations for your legal liability under the 33 Act for your registration statement. And in sort of the normal times, that was particularly interesting for plaintiffs because people didn't necessarily do a ton of follow-on offerings or whatever. And it's also the case that until recently, we would see people, if their stock price fell below their IPO price, we would see litigation both in state and federal court. So lots and lots of reasons for an insurance carrier to charge more and be worried about real exposure for the first 3 years of going public. And it's also true that, and I'm sure not any of our participants who decided to listen today, but other people who don't listen to advice, the first 3 years, new public companies, if you're going to stumble, it's probably that during that time, right? It's just new training wheel situation. And so what we would typically see is pretty steady pricing for the first 3 years, and then things getting much better after you exited the IPO window. Again, macroeconomic factors can completely upend that. And my clients that went public in 2019 and earlier, actually, as they were exiting the window, the market inflated the price. And so that just was what it was. The other thing, remember, is very often you hope 3 years later, you're bigger than when you went public, right? Like that's usually the goal. The goal is not to go public and steady state. Come on, steady state. That's not what we're doing. And so if the company is just bigger companies do axiomatically pay more for their insurance than smaller companies, almost always. So those are the factors. But if the company were the same, I would expect it to be less after you exit that 3-year window. One more time, that's not the goal though, right? The goal is to be bigger.
Yeah. Understood. Okay. Ninos, you've talked about regulation, various items. What is the administrative burden on your time and finance the increase once a company is public?
I would say it's time for sure, and you need someone dedicated to it. For example, we hired a financial reporting and technical accounting senior manager just before we went public, and we've had to supplement that with either consultants or people across the team. So there's probably at least one head in there, right, by way of quantification. The risk management aspect, there's definitely been, you work very closely with legal and corporate legal, and, there's been an increase in the size of that team, adding headcount to, again, manage or the legal aspect, and whether it's reviewing Qs or Ks or process and policy documentation updates. So there's definitely an aspect of that team growing, as well as finance and accounting. But yeah, it's absolutely something that you should be considering and making sure you're hiring up for. And if you can't or don't find the right people, there are plenty of advisors, including the folks on this panel, that would be absolutely willing to help, and again have playbooks and knowledge from all sorts of companies and all sorts of different situations. So there's lots of people that can help with that.
Excellent. Thank you. Richard, last question. We spent quite a bit of time talking about attracting board members. Do you have any tips to attracting a good audit committee chair or cybersecurity? What you're seeing right now could even be ESG, as you're seeing the regulation increase. Do you have some tips on maybe some of those key roles that may have been a little bit different several years ago?
Yeah, I do think that, and I think it was Priya who made this point, so I'll steal it and make it again and give her the credit. I think using your personal networks is really, really key, and not just your personal networks, but also the networks of the board members who are with you. And I mean, it was funny. This was really driven home for me when I was a new partner. And I remember we had one company who was doing some board recruiting, and like we had gone through this whole thing of negotiating this board recruitment, engagement letter with this professional recruiter. And like they were coming to the NomGov meeting, and it was going to be this big presentation, and they get down, everyone's like, they get engaged, and they're all sitting down. And literally the first thing that the board recruitment folks said when they sat down with the NomGov committee is, okay, who are the people who are your friends who you want us to reach out to? And I was like, wait a minute. Like we can reach out to the people that we know. Like I thought we were hiring you so that you could find the people that we don't know. I guess that is what it is. But I do think that on so many boards that I've seen, there are people who have worked together in the past, either at a company when they were in industry before they became directors or on some other board. And so I do think that if you're director of recruiting is a lot about the people that you know and reaching out to your networks. And sometimes that's the networks of the people on the board, that's the networks of the executives of the company, it's the networks of your trusted advisors. But that's where it starts. And it may reach out from there, but starting with the people that you know is the right first place to start, as the board recruitment company will tell you if you hire them.
Excellent. I had not heard that. All right. Well, as I turn it over to Colin for the closing remarks, I just want to thank very much panelists, Richard, Priya, and Ninos. Good to see all of you again, and I certainly appreciate you joining me on this call today.
Thank you. Thanks for having us.
Thank you. Thank you.
Thank you, Katie, for leading such a wonderful discussion and landing this IPO Bootcamp plane. Richard, Priya, Ninos, thank you so much for contributing your real-time, real-world experience to our community who's interested in learning about the listing process. So it's great to have some of you back, and great to have you contributing all of this great knowledge. For those of you still on, we'd love to hear from you. And if you want to hear from our partners, just fill out that link in the chat. We hope this was insightful and helpful. Look forward to hopefully what's an optimistic year in the listings market for 2023. But on behalf of everyone who is on our team and everyone in attendance, thank you so much. And we look forward to welcoming you all back online soon. Thanks again, team.